Hello everyone, Radhe Radhe. In today's lecture, I am going to revise all the concepts of the mergers, acquisitions and corporate restructuring chapter in a great detail for all of you students. And as soon as we complete our conceptual revision for all the topics, I will also walk you through some important specific questions along with their specific points right away. We will go through all the questions we solved in our regular lectures one more time. So you can understand here before we start our revision, let me tell you a few things. You see this chapter, we covered it in a total of 5 parts in which we studied around 24 topics. So when we started this chapter, I expressly told you not to get scared by just looking at this chart and thinking that this chapter is so big and it's huge. It's a long chapter with so many topics, it must be very tough. I told you that there is no chapter easier than this. If you just understand it, this chapter may seem to have a lot of topics, but they are all small topics that once you understand them, nothing left behind. So this chapter is the easiest of all. I can guarantee you that right now. We have covered all the questions that are there in our regular lectures, and this is for those only revising. You will not face any difficulty in this chapter. Just keep following what I tell you. So this chapter doesn't really have any new topics. The topics we have already studied in previous chapters or the fundamental basics of AFM are indeed what we are going to use in this chapter, and we just have to apply them in a slightly different way. To explain what we need to learn in this chapter, I have created the first part for you, a general introduction to mergers, acquisitions and corporate restructuring. In this, you first need to understand the meaning of corporate restructuring. Only then will you understand what this chapter wants to teach you. So first I've created a topic, meaning of corporate restructuring. So what does corporate restructuring mean? Will the exam ask this? No, the exam doesn't ask these things. You just need to know it so you can understand what you're going to learn in this chapter. So corporate restructuring is a process in which a company strategically reorganizes its overall operations. The company reorganizes its business operations primarily to increase its efficiency and to bring further growth into its business. The company wants to reorganize its operations and its overall business to foster efficiency or to achieve growth within itself. To achieve this, there are indeed many methods which are commonly called the types of corporate restructuring. Out of those, I have noted down some types here, such as mergers and acquisitions, demerger, reconstruction or financial restructuring, stock split up and bonus issue, equity buyback, which you also call ownership restructuring. So these are the 6 types of corporate restructuring, and these very 6 types of corporate restructuring are part of your syllabus for this chapter, which you have to study. So what exactly do we need to study in this chapter? Let me give you a basic idea. As we move forward with these topics, we'll have to study all these topics, so we'll discuss them in more detail then. First, if I talk about mergers and acquisitions, you have already studied this somewhere before. What does mergers and acquisitions mean? It means buying another company. I want to buy it and merge it into my own company. For mergers and acquisitions, you've studied amalgamation accounting in intermediate. At the final level, AFR also covers this accounting as per Ind AS. You have studied mergers and acquisitions, but from an accounting perspective. Similarly, what exactly is a demerger? Demerger means, let's say a company has 2 businesses in its portfolio, one for laptops and one for mobiles within the same company. The company feels its management focuses on the laptop business and not the mobile business. So what is the company doing? It's separating the mobile division and creating another company. This is done so that the new company can fully focus on that business, further allowing that business to grow as well. So this is a demerger. Similarly, reconstruction or financial restructuring, you have studied as internal reconstruction in accounting at the intermediate level. It happens when a company's internal financial condition is very poor. So the company reconstructs itself. Why and what it does, we will look at all that in detail again. After this, the stock split up, in which the company splits its shares. Bonus issue, the company issues free bonus shares to its shareholders. Then equity buyback. The company, from its total outstanding shares in the market, it buys back some of the shares from the shareholders. This is primarily done to change the ownership structure, as the company might require it. These are 6 types of corporate restructuring, and let me tell you, all 6 of these you have already studied. But in accounting, you have learned the accounting for all of these somewhere up to the intermediate level. But when we are speaking of the accounting, so you need to clearly know that, will this chapter again cover the accounting for all these types of corporate restructuring in this subject? Will we be asked about the accounting of all of them again? This point should be clear to you now, that this subject doesn't teach accounting and it's about decision making. We don't have to study the accounting of these subjects. So what do we learn? What will we learn in these 6 topics in this subject? It's very simple. Look, here you have to do decision making. If I give an example of merger and acquisition, I am A Limited and facing the Reliance Limited. It has been my childhood passion to buy Reliance Limited and merge it into my company. So I have to make a decision on what impact buying it will have on me. Or what impact will it have on the shareholders of the other company? What will be the benefits of the merger? What will be the drawbacks? What will our market price become? How much money should be paid? All these calculations, meaning the calculations needed for decision making. All of that has to be done. Similarly, in demerger, reconstruction, stock split up, bonus issue, and equity buyback, you have to do decision making calculations. For instance, if I issue a bonus, how will it affect my company's earnings? How will it affect my company's market price? Similarly, we must perform decision-making calculations on an equity buyback's market price impact, meaning this subject comes into play before a transaction happens. Once you complete a merger and acquisition, then the transaction is done. Now any intended impact has already occurred, so there is no decision-making left, and you will just go and perform the accounting. So after the transaction is done, the work belongs to the accounting subject. And the phase before a transaction, that's exactly when this subject truly plays its vital role, because at that specific time you have to make a decision on whether to do this transaction or not. So in this subject, these types of corporate restructuring, in all of these you have to do the decision making part, assuming your transaction is about to happen. So you should then decide to do this transaction or not. Based on that, you will check some of the impacts and so on. So understand, this is all what you do in this chapter. So the name of this chapter should be corporate restructuring. These are detailed things that I discuss in regular lectures, but I'll mention them once here as well. We have to discuss all types of corporate restructuring, right? But this chapter is named mergers, acquisitions, and corporate restructuring. Why is that? Well, the merger and acquisition type of corporate restructuring is the primary focus. The institute's main focus in this chapter is on this type. Whenever a question comes in the exam from this chapter, it is mainly on this type. Questions only related to mergers and acquisitions are asked. All the other types of corporate restructuring are of less importance. They have very small points. They will be completed quickly once you are done with this. There isn't much in them, and not many questions are asked from them in the exam either. The main focus is on this. That's why the institute named it mergers and acquisitions, and then said also study other types of corporate restructuring. Hence mergers, acquisitions, and corporate restructuring is the name. What you need to learn in this chapter should be clear to you, and then let us move forward. Our main focus of this chapter is on mergers and acquisitions. So I'm telling you some basics of mergers and acquisitions in the introduction part. Look, these specific fundamental basics don't have direct questions. As you know, my teaching method, I teach you everything in a structured way, and then first we look at all the crucial basics that are needed. First, I have already provided you with the fundamental basics for our entire subject, including specific essential concepts that would be useful across all chapters right at the very beginning. Those will be useful in every chapter and are used in this chapter. When we did the solutions in class, remember that. All essential basics we saw for AFM were used. So you should revise those first. After that, these are specific basics for merger and acquisition questions. If you want to study the mergers and acquisitions, you must know these basics first. If you don't know these, when you go into the calculations of mergers and acquisitions later, you will always be in doubt. You will get stuck and your logic will not be clear. I always say to listen to this carefully. So the focus should always be on these basics. Now in the mergers and acquisitions basics, first we will cover their meaning. What is the meaning of mergers and acquisitions, which we call M&A in short? What is its meaning? First, we should know what merger and acquisition mean. So will this be in the exam? No. Their meanings and all will not come in the exam. So why are we studying this? Well, first you should know why you are studying it. Second, I will tell you a specific point in this about what the institute understands by merger and acquisition in this chapter. What is its meaning for FM decision making purposes? You should know that it will have a lot of relevance in the questions. I will tell you now how it will have relevance. So the meaning of merger and acquisition is it usually occurs when one company buys another company. Meaning when one company buys the another company and merges it into itself. You will call this a merger and acquisition. That is unification of two entities into one. This means two companies come together as one. Two companies both combine to form one entity. Remember our example. This is a fixed example with which I explained the entire chapter in the regular class. I am A Limited in front of Reliance Limited. It was my childhood passion to make Reliance Limited my own. So I am buying the Reliance Limited, acquiring it, and after acquiring it, I am merging it into my company. Acquiring and merging it into my company. I am one company buying and merging another into myself. So with this, two entities are combining to form one. Understood? You always have to remember this. Now I will tell you some specific things. Look, as soon as I said this meaning, it might come to your mind. Some people start linking it to the accounting part. Let me tell you, whenever you study any chapter, any subject, you should not go outside of that subject. When you study FM, avoid bringing in accounting or other subjects because every subject has its own distinct concepts, its own way of thinking. I tell you this every time in the regular class. I am saying it again here. Because this is the biggest mistake that students truly make, and other students will always make this mistake because they have a habit of linking where it is not applicable. So you should never make this linkage, because those who have studied the accounting of merger and acquisition, we study accounting in great detail in FR. So when we study accounting there, we understand that this is the meaning of merger. This is the meaning of acquisition. This case is called acquisition. This case is called merger. In a merger, this is how we think, and accounting is done accordingly. In acquisition, this is the way of thinking, and accordingly this accounting should be done. It is taught in complete detail. If any student has studied accounting with focus, they will start linking these things. So they think, sir, the meaning of merger and acquisition was different there, and here you are giving the same meaning for merger and acquisition. Whenever you talk about our decision making, the terms merger and acquisition will have the very same meaning, whether the question says merger acquisition or merger and acquisition. You will never differentiate. It's the same meaning. What is the meaning? You are buying the other company and merging it into your own. What happens with this? The other company will stop running separately. It will have no separate existence left. I went and merged Reliance Limited into my own company. Look, for decision making purposes, you don't need to do a detailed bifurcation of whether this scenario is a merger or an acquisition. Those are ways of thinking for accounting. The accounting rules are according to that. That's why we think that way during accounting. In the decision making, we actually don't think about whether it falls into this scenario or that scenario. Here we have to make a decision to buy the other company, so keep one thought process in mind, which the institute also follows. The institute will follow this thought process for all questions, so keep this point clearly in your mind. You are always buying the other company and then merging it into your own. This is what you will call a merger and acquisition. The meaning, merger or acquisition, should be clear now. Understood? As soon as I buy the other company and merge it into my own, the other company will stop running separately. It will have no separate existence left. That company will be shut down separately because I have merged it into my own. Meaning the acquirer company is expanding its scope. The acquirer company is raising its level through merger and acquisition. I had explained this in the class with another silly example, but still, it would help you understand. Look, what did I say? So let's say I have a building and my building has one floor, but there is another one floor building next to it. What I did was I took that other one floor building and stuck it on top of my building. I have a one floor building and there was another one floor building. I put it on top of mine. So my building became 1 + 1, a 2-floor building. But the place where the other building was is now empty. So this is exactly how you need to understand merger and acquisition in FM for decision making. You picked up the other company, meaning you acquired it and merged it into your own. The other company stopped running separately and my scope, my level increased. Who am I? The acquirer. Meaning now my level has increased. After the merger, the level of the merged entity increases. After the merger, the acquirer's level increases. The acquirer's level increases. You should know this. If this point is clear, you'll never get stuck in a question. Otherwise, you'll always be stuck thinking, sir, we understood this meaning of merger and that of acquisition. That's why I spent time here. After this, the purchasing company, the company that is buying, you'll always call it the acquirer company. And the company that is being sold, the selling company, you will call it the target company, target. This is a common wording in this chapter that will be used in every question and while understanding every concept. So get this fixed in your mind. Alright, so the company that is buying, IMA Limited. I'm buying Reliance, so I'm the acquirer. What is the other company doing? It's being sold. I'm buying Reliance, so it is being sold. So you'll call it target. Why target? Because it was on my target since childhood. It was my passion to buy it since childhood. So that company was on my target. That's why the other company is called the target company. So this is the meaning of merger and acquisition, which should be clear for decision making purposes. This will be common meaning throughout the chapter. You should not have any ifs and buts in this. And then carefully consider this next point. Look, now I will talk about buying the other company. So whenever you buy anything, it doesn't come for free. You have to pay money for it. Whom do you pay the money to? The owners. Let's say you want to buy a laptop from the market, and if you buy a laptop, you will pay its owner. Similarly, when I am buying a company, I definitely have to pay its owners. Who are the owners? The shareholders. So I have to give consideration to the shareholders of the target company. Consideration must be given to the target company's shareholders as they are the owners. Are they equity or preference? I had clarified this during the basics of AFM. Preference hardly exists. It might be only found in 1 or 2 questions in some topic, and it's definitely not in this chapter. Okay, so forget about preference because it doesn't exist practically. Otherwise, it's equity, so we consider them equity shareholders. When I write the word shareholders, it's always about equity. I had told you this assumption during the basics of AFM. It's always equity. Equity holders are the owners. I have to give consideration to the shareholders of the target company or its owners. So the consideration that is given, there are 2 ways to give it. The consideration that I will pay to buy the other company, there are two distinct ways to discharge it, to give it to them. One way is to pay cash to the shareholders, the owners of the other company. I'll say, here's the cash, sign your company over to me, and now you can leave. It's simple, take the cash, sign the company over and leave. This is a simple method, that is by paying cash. I can also pay the consideration in cash, which is called a cash offer. I am making a cash offer to the other party. There is another way, by issuing the equity shares of the acquirer company. Issuing acquirer company equity shares or a share offer. What is this method? I went to buy the other company. So I talked about buying the other company and I told its shareholders. I said, look people, you need money for your company's value. Suppose it is 10 crore rupees and we have agreed on this. One method is for me to give 10 crore in cash and take the company. Another way, I said you need 10 crore rupees, right? Instead of 10 crore rupees in cash, I will issue the equity shares of my company to you. I will issue my own company's equity shares to you. You are concerned with the consideration, right? I will give you equity shares worth 10 crore rupees. You need an amount of 10 crore rupees to sell that company. So I will issue equity shares of my company worth exactly that amount to you, and the consideration can always be given in any form. I can give cash or I can give something else of that worth. So I issued my company's equity shares, which is called a shares offer. I offered my shares to the other party. I am the acquirer. Look carefully, the acquirer is offering shares. Many people get confused here. There should be no confusion here. I have to buy his company. I can give cash directly from my pocket or I can issue my company's equity shares. So I am issuing my company's equity shares. So the acquirer issues its equity shares and gives them to the target shareholders. As consideration, I gave you another simple example, a very general one to make it clearer. Say, I went to market to buy a laptop. The seller said it was for rupees 1 lakh. I gave 1 lakh rupees and got laptop in my name. No problem, right? Now consider the second scenario. Suppose I am a big company owner and I once went to a shop to buy a laptop. The laptop cost 1 lakh rupees. I said, give me this. He asked for 1 lakh rupees. I said, I am the owner of a very large company and I don't carry cash. He said, you simply must give consideration because I cannot give the laptop free. I said, that's right, but look, my company is a very big company. You also know that. He said, yes, sir. Do one thing, I will give you equity shares of my company worth 1 lakh rupees. So you give me the laptop. He said, yes, sir, no problem. I'm concerned with the consideration. I am happy to take your company's shares. My value will increase. And even if it doesn't, I will sell the shares in the market now and get 1 lakh rupees back. Now you can see I can give consideration in any form. A mutual agreement. Understood? So these are the two ways to give consideration to the shareholders of the other company. You buy goods from them. Think normally buying a company is like buying goods and in return you give consideration. Now look, these are two ways of giving consideration. The entire chapter is based on this. How is the chapter based on this? Pay attention. Look, we have this share offer method and then there's also this cash offer. The 5 parts I gave you for this chapter, in which I said I will teach in 5 parts. Part 2 is merger and acquisition through shares offer, and part 3 is also through cash offer. Meaning when you offer consideration in the shares. In such a case, when a merger and acquisition happens, what calculations will be involved in decision making? We will learn that. And when we offer cash as consideration to the other party, in that case, what calculations will be involved in decision making in a merger and acquisition? We will learn that in the third part. From an exam perspective, these specific topics have the most questions. Part 2nd and 3rd. In which the most important is part 2, this one. The one where consideration is given through a share offer. Mostly questions in exam come from this part. Understand properly. After that, there is nothing in the chapter. So that was the first point in your basics. After this, look at next point in basics. What's the next basic point? Promoters and non-promoters holding in a company. To understand, you need to know some details. A company typically issues its equity shares in the open market. I had given you an example. Let's understand with the same. Let's take the example of Reliance Limited. Reliance Limited, the company we are considering now. That company has indeed issued 1 lakh shares in the market, and these are formally called the number of equity shares outstanding. Look, any company that issues equity shares in the market, equity shares issued are called outstanding shares. A basic wording you should know well, as it will be used consistently throughout the chapter. This term equity shares outstanding, you have learned since starting commerce in 11th grade. The shares issued in the market are called equity shares outstanding. Why are they called outstanding? As that term is for liabilities. Equity shares are a liability. Recall your childhood lessons. Balance sheet equity share capital was on the liability side. Similarly, you used to show all other liabilities and so on. Why on the liability side? Because You have to pay money against them. You initially collected money from equity shareholders, so you have to pay them back in future. The only thing is the amount to be paid to them is not fixed. If the company has money, it will pay. If not, their money will also be lost. Paying other liabilities is mandatory. That's the only difference. Otherwise, these equity holders are also a type of liability. That's why they are called outstanding shares. A company has issued, let's say, 1 lakh shares in the market. Really? Understood? So this represents the equity shares outstanding, 1 lakh. Now look, the Reliance company. You have studied about companies. I am telling you some basic things that are necessary for you to understand this topic, which you have learned in your childhood during commerce. You have read about a company that it is a separate legal entity. It is a separate legal entity. A company is a separate entity in itself. So this company is a separate legal entity. So it is issuing shares in the market, right? It has to raise money for that so that it can bring in capital and then invest that money in the business. So who creates the company? Think about it. It's a separate legal entity, but someone must have created it because it's not a living thing. It's a non-living entity. A company doesn't create itself. So one day Ambani had an idea. He had an idea that he wanted to open Reliance company. So he went and registered the company and created Reliance Limited. So who is the actual owner of Reliance Limited? Ambani. Actually, the owner of Reliance Limited is Ambani. These people are called promoters. The individuals who are responsible for creating the company and bringing it into existence, they are commonly called promoters. These are indeed the people who have successfully promoted the company into being. So Ambani is the promoter of Reliance Limited. So actually Ambani is the owner of this company. But we have properly read in the Companies Act that the person who holds the equity shares of a company, that is whoever is the equity shareholder of that company, is the owner of that company. We know that the equity shareholder is the owner. Legally speaking, the equity shareholder is the owner, but in reality, the promoters are the owners. Ambani had an idea, I want to start a company. He created Reliance Limited. The company is issuing shares in market. People who have those shares, you'll call them owners. So Ambani will say, am I a fool? I built this company and others get ownership. So how is this possible? Legally, Ambani cannot be the owner. For this, look, there is a provision if you read the Companies Act or SEBI regulations. So here, when a company is created, it issues shares in the market. So when they issue shares, it is mandatory for the promoters to take some of those shares. The promoters have to buy some of those shares. The promoters themselves invest in those shares. The promoters have to make a minimum investment in those shares. Why was this rule made? So that the promoters can get control of this company. He must be the legal owner. When does he become owner? By holding the company's equity shares. So some shares of the company are held by the promoters, meaning the shares that the company issues in the market are held by two categories of people. One is promoters and other one is the non-promoter minority. One is promoters and one is non-promoters. Two types of people hold the shares. Now these promoters can have any number of shares, 30, 40, 50, 60%. How will control come with 30, 40%? That is a different part. There is a definition of control. This is not part of your syllabus, so we won't discuss. Alright, so did you understand? When a company issues shares in the market, two types of people can invest in those shares. One is promoters and one is non-promoters. Two people do. Assume that Reliance Limited issued 1 lakh shares in the market. Of these, 60% of the shares were taken by Ambani himself, meaning he invested in 60,000 shares. This means the shares held by the promoter. And plus, what about the remaining 40,000 shares? As soon as the company issued 1 lakh shares, Ambani acquired 60,000. The remaining 40,000 shares, the company will go and list them on the stock market. You know NSE, BSE, right? The stock exchange. It will list them there. And the rest of the general public, people like you, people like me, people like us go and buy those shares. Some buy 100 shares, others 10 or even 50. So people like us are the minority shareholders because we have few shares. Non-promoters. We are not company promoters. A company's shares are held by two types of people, promoters and non-promoters. It is important to know this as it will come up in questions. A direct question. Understood? You should know this. Then I will tell you one more specific thing in detail for your knowledge purposes. The shares you see being traded in the market in the stock exchange are only these non-promoter shares, the minority ones. Promoters' shares are never available for trading in the market. Promoters keep their shares with themselves. Only non-promoter, minority shares are available for market trading, where buying and selling occurs. Those 40,000 shares. Understood? So you should be clear on this point. When a company issues shares in the market, two types of people invest in them. One is promoters and the other is non-promoters. You should know this. If you are asked in a question to state the promoter's holding percentage, what is the promoter's holding percentage in company and how many shares have the promoters held? It's very simple. How many shares do promoters have in our example? 60,000. Divide by total issued shares, 1 lakh into 100. Promoters' equity shares divided by outstanding shares into 100. In our example, that's 60%. Similarly, if the non-promoters holding percentage is asked, it's the number of shares the non-promoters have divided by the total equity shares outstanding and then multiplied by 100. You should know this basic point. It will be useful somewhere in the questions. The institute asks this sometimes. After this, our third basic point is types of market capitalization. I had also told you about market capitalization in the basics of AFM. Now we'll talk about it in a little more detail in this chapter. Market capitalization can be of two types. One is normal market capitalization, as discussed in the basics, often simply called market capitalization, and this means total market capitalization. This means total market capitalization. The word total is not written explicitly. It is written as market capitalization, but it means total market capitalization. It represents the total market value of all equity shareholders, and this concept was extensively explained in the basics of AFM. The market value of total shares represents the market value of all equity shareholders. It doesn't matter if they are promoters or non-promoters. All company equity shareholders are included. What is the market value of all? The market value of one share of company, that is MPS market price per share, multiplied by the total number of shares, that is the number of equity shares outstanding. So in our previous example, suppose the market price of one share was rupees 10. Equity shares outstanding were 1 lakh and market capitalization became 10 lakh. There is another way to calculate this. EAT, ESH into PE ratio, what is that? Earning available to equity shareholders. Go back to the basics of AFM. Everything has been taught, meaning all the things I covered in the basics are repeated again and again. So you should remember them. We prepared a statement. EAT ESH into PE ratio gives market capitalization, and the PE ratio formula was MPS by EPS. Multiply MPS by the number of shares, then EPS by the number of shares. MPS times shares, market capitalization. What is EPS into shares? Earning for equity shareholders. So in order to find the earning available to equity shareholders, what will be the formula then? Okay, let me correct. To find market capitalization, earning of equity shareholders into PE ratio. I have derived this and explained it during the basics. We will not go into detail. The second type of market capitalization is free float market capitalization. What does free float market capitalization mean? It's the market value of non-promoter shareholders. The non-promoters, meaning the minority equity shareholders, what is their market value? Minority shareholders mean the equity shares held by the minority. In our example, 40,000 shares times the shares market price, meaning how many shares do the minority people, the non-promoters have, multiply that by the price of one share and you will get the free float market capitalization. This is sometimes asked. So why is it called free float market capitalization? I just gave you a clarification that the shares which are traded in the market, only the non-promoter minority shares are actively traded. Alright, promoters' shares are never traded in the market. Only the minority shares are available for trading in the market, and these shares are freely floating. They are freely available for trading. Their floating is freely available in the market. That's why it is called free float market capitalization. Meaning such shares that are in the free float in the market, meaning those that are traded, meaning those you can buy and sell, the market value of those shares, meaning the market value of non-promoter shares. You have to remember this. Now you know what mistake some students make. They calculate this. Market capitalization is asked. So what do they think in a hurry? That free float is non-promoter market value. So normal market capitalization must be market value of promoters. Don't make this mistake. It means market value of total shareholders, promoters plus non-promoters. Alright, I am also telling you the points where you make mistakes in the exam in a hurry. So these were your basics, the introduction part of this chapter. Now let's move to part 2, mergers and acquisitions share offer. If you do a merger and acquisition through a share offer, what calculations will be involved in decision making? The most important part, from which the most questions are asked in the exam in this chapter. So this is what you need to understand well. So now we will revise its concepts. Look, let's understand once again what mergers and acquisitions through shares offer means. I'm A Limited. In front of me is Reliance Limited. I decided that I want to buy, so I went to its owners, its shareholders. I said that you should transfer your Reliance Limited in my name. I will acquire it and merge it into my company and expand my scope. Understood? I am repeating these things so that you remember them. To accomplish this, the consideration I will give to you, I want to give it by issuing my company's equity shares. I am the acquirer. So the acquirer wants to give consideration to the shareholders of the other company by issuing his company's equity shares, meaning I want to make a share offer. So in this case, the decision making I have to do, how will it be done, and what calculations will I do? When I teach this part, which we will study, I will revise the concepts. I had mentioned this in regular lectures and I am repeating it here. When studying this part, please do not even consider cash offers. If you mix that, then you'll certainly forget mixing and the whole topic will surely become a complete maze. Alright, so from your mind. It won't be clear at all otherwise. I will then easily link the cash offer for you. So for now, you should only have share offer in your mind. You should not even think about cash offer. We'll discuss the share offer case. So look, if I do a merger and acquisition through a shares offer, so the first topic in this, what is the requirement? How many shares to be given to other party as consideration? This is the first calculation I will do. How many equity shares of my company am I issuing to them? How many acquirer equity shares should be issued to target shareholders? To the target company's shareholders who are in fact the owners. How many equity shares of my company will I issue? What will be the first point that comes to my mind? If a merger and acquisition is to be done through a share offer, then how many shares should I issue to the shareholders of the other company? How many shares of my company should I issue to other shareholders? This will be the first point that comes to your mind. So I had taken an example. Suppose this is the example. We'll understand this now. It's very easy. I've written acquirer and target company. The number of equity shares outstanding for both companies is given in the question. It is 1 lakh and 1 lakh. The acquirer has 1 lakh shares outstanding issued in market. There has been no merger yet, only pre-merger details. Normal data of 2 separate companies is given. We are not talking about a merged entity because currently the acquirer has issued 1 lakh shares in the market. Similarly, the target company has issued 1 lakh shares in the market. I am A Limited and my example here, the target is Reliance. It has also issued 1 lakh shares in market. Let me think. How many shares of my own company should I issue to the shareholders of that other company so that they transfer their company over to me? How many shares will I issue to them? And you may actually wonder how many shares to issue. If you think about it, a point will come to your mind. The shareholders of the target company, meaning they have invested their money in that company and they have invested in the equity shares of the target company. How many shares do target shareholders have? 1 lakh. Well, the target company has issued 1 lakh shares in the market. Shareholders hold 1 lakh target company shares. I am buying that company from those shareholders in which they have invested through 1 lakh shares. So in return, I want to give them shares of my company. I will tell them, look, you previously had shares in that company. Now you take my company's shares and in return just transfer your company to my name. Isn't that the deal? Then you will think they had 1 lakh shares of the target company. So you as the acquirer, whenever I speak about myself, understand I'm talking about the acquirer. So you should issue 1 lakh shares of your company to them. They only had 1 lakh shares of the target company, right? So acquirer will issue another 1 lakh of its shares and give to them. To ensure they have the same number of shares, will this happen? If so, there is no need to teach this topic at all. That's not how it really works. For instance, imagine the target company shareholders had 2 lakh shares. So would I issue 2 lakh shares of my company to them? Shares are not issued directly like this. You issue the same number of shares the target company's shareholders had in their company. I'm addressing the doubts that might generally come to your mind if you study the concept. Some people overthink it and these thoughts come to those who unnecessarily overanalyze. This approach is incorrect and you must truly understand the reason. What is the reason? Check the market prices for both companies. The market price of one share of my company is rupees 50 and the market price of one share of the other company is rupees 40. The target company's market price per share is rupees 40. So just think about it. One share of the target company has a significantly lower value compared to my share. A target company's share has less value compared to mine. So how can I give one of my shares in exchange for one of theirs? How can I give one of my shares to the shareholders of the target company in exchange for one share of their company? Their share has a much lower value than mine. Did you get my point? You have to think logically. So for this case, for this reason, the number of equity shares that the acquirer will issue to the target's shareholders. For that, I have explained the working in 2 steps, or you will get the answer in 2 steps. You have to follow this as it is, whatever steps I provide. Friends, not a single question of yours will get stuck. But if you just follow random market notes from anywhere, you will merely keep trying and never gain clarity in this chapter. Just follow this. First of all, you calculate the exchange ratio, which you can also call the swap ratio. In short, we will call it ER. ER is the abbreviation and it is the short form. I will be writing such abbreviations many times in this chapter. Remember these abbreviations for understanding concepts to grasp the chapter well. You don't need to write them in the exam. I'll clarify this later on. Keep these abbreviations in mind for understanding concepts. First, calculate the exchange or swap ratio. What does this mean? For the shares of the target company, how many of my shares should I give in exchange for their shares, as this simply means giving something in return. I must issue my company's shares to target company shareholders. Target shareholders held the target company's shares. So for the shares they held, how many of my shares should I give in return? This ratio will be clearly known as the exchange ratio, and we need to determine this. Now, how will we figure this out? We have two specific ways. The exchange ratio can be based on two things, and these are either a positive parameter or a negative parameter. What are the positive parameters? EPS, MPS, BVPS, all these. EPS means earning per share, MPS is market price per share, BVPS, book value per share. This was formula told during your basics of AFM. Negative parameters like NPA, non-performing assets in banks, we will discuss later. First, let's cover positive parameters. When deciding an exchange ratio, companies will meet. I am A Limited and the other side are Reliance Limited shareholders, and we will have a meeting. In the meeting, we will discuss that we want to buy the company. Tell us what exchange ratio we should give you. So we will have a discussion, and during this important discussion, we will decide whether to use EPS, MPS or BVPS as the basis for the exchange ratio. Your exchange ratio will be based on that. How is the exchange ratio calculated? Take the parameter of the target divided by the parameter of the acquirer. Is this the formula? There are no formulas in this chapter. These are things built conceptually. This is not a formula. You don't have to write this formula in the exam. You have to do the calculation. You won't find a formula in the book. These are made to understand the concept. It's a logical formula in a way that is derived logically. I'll explain their mathematical derivation now. This working continues throughout the chapter, and you need not write these formulas in the exam. They are only written in the notes for your revision. You can divide the target's parameter by the acquirer's parameter. How and why we are doing all this, you will understand now. Once this topic is done, you will start understanding all the topics in this chapter in a sequence. Understand this topic carefully. Look what's in our example. In our example, the acquirer and target are two companies, and they both have issued 1 lakh shares each. Alright, both have issued 1 lakh shares each. What is the share price of the acquirer? Acquirer's share price is 50, target's is 40. We said that we will decide the exchange ratio based on MPS. So if we have to decide on the basis of MPS, then the parameter of the target is 40 MPS. Parameter means the target's MPS. It is divided by the acquirer's MPS. So it's the target's MPS divided by the acquirer's MPS. So 40 by 50, which is 4 by 5, equals 0.80. This means 0.80 is to 1 when nothing is written in denominator for 0.80. It's understood as 1. You know, division results can also be written with 2 or ratio sign. Writing 0.80 is to 1 means 0.80 divided by 1. These are the fundamental mathematical concepts. This is your exchange ratio. This means that for every 1 share of the target company, I'll issue 0.80 of my shares. In exchange for 1 of their shares, I'm going to issue 0.80 of my own shares. So, you know, how was this derived? How was this logic formed? It's very easy now, understand. As acquirer, my company's share is valued at 50 rupees. I have to issue my shares. What to do? I have to issue my company's shares to the shareholders of the target company. So my share is worth rupees 50. Now in comparison to my share, what is the value of their share? It's 40. So compared to my share, just tell me what is the worth of their share in comparison to mine. My share will be in the denominator and their share in the numerator. It's basic mathematics to think about. I have to issue my share. So my share is worth rupees 50. When compared to my 50 rupee share, what is their share worth? It is 40. Compared to my share, the value of the other company's share is 0.80. Other company's share value is 0.80. This means if I give 0.80 of my shares for 1 of their shares, then the account is settled. It's balanced. You should not just issue shares equally. You must always consider their true value. So the value of 1 of my shares is 50 and value of their share is 40. So the comparison between my share and their share is 0.80, meaning their share is 0.80 of my share's value. So their 1 share is worth 0.80 as compared to mine. So for their 1 share, I will give 0.80 of my company's share to them. Understood? So for their 1 share, for every 1 share of theirs, for every 1 share of the target, I will issue 0.80 shares of my company. How many shares did the target company issue? 1 lakh. So 1 lakh shareholders, that's 1 lakh shares. I'll issue 80,000 shares of my company to them according to the 0.80 ratio. You know, it's a very simple matter. So for 1 of their shares, I will give 0.80 of my own. So for 1 lakh, I'll give 1 lakh into 0.80. I've used basic unitary method of mathematics. Have you understood the calculation? This is the whole trick. Understood? So you see, what do these positive parameters mean? They are parameters that reflect a positive aspect, meaning they reflect the company's growth. This means that the higher these parameters are, the better it is for the company's growth. And tell me, is it better if the company's EPS is low or if it actually increases? So the EPS will be higher. Similarly, the higher the MPS and book value per share, the better it is. So in such parameters, target is on top and acquirers at bottom. For example, calculation based on EPS. EPS of target divided by EPS of acquirer. If calculating based on BVPS, divide the target's BVPS by the acquirer's BVPS. What is the target's parameter value as compared to the acquirer? According to that, we will give the exchange ratio. Okay, so let's say the acquirer's EPS is 5, the target's is 3, and you have to find the exchange ratio based on EPS, so it's 3 by 5. The acquirer's BVPS is 15 and the target's is 12. Is there a fixed exchange ratio? No, it's 12 by 15. Logically, this formula isn't derived from anything. It is created logically. It's completely logical. There's nothing special about it. You will understand it. So what if it was like this? Now the acquirer's MPS 50, exchange ratio by MPS. The market price per share of the target company is 100, so it would be 100 by 50, which comes to 21. Is this possible? Yes, it is absolutely possible. If the share price of the target company is higher than mine, that means the target company is better than mine. For one of their shares, I will certainly have to provide more of my own shares to their shareholders. Their share is 100, mine is 50, the ratio is 2:1. What does this mean? It means for one of their shares, I have to issue 2 of my shares. And it's obvious that the other company is better than mine. Well, these parameters are positive ones. They clearly show how good that company is compared to mine, reflecting its higher market price. I will issue 2 of my shares for each target company's share. Alright, for one share, we will give 2. This is a very logical and simple method. Let's consider negative parameters now. For instance, NPA generally happens with banks in specific merger situations. Banks have NPA, meaning non-performing asset. Bank's non-performing asset means bank gave loan to someone and is unable to recover it, meaning bank is incurring loss. So that is the NPA percentage. Banks calculate the NPA percentage. The banks have calculated the NPA percentage. The acquirer bank had an NPA percentage of 5 and the target bank had an NPA percentage of suppose 20. This will be given in the question. You are asked to calculate the exchange ratio and you will think target's parameter, their NPA of 20. Acquirer's parameter, which is the acquirer's NPA. This comes to 4:1. For one share of the target company, I must issue 4 of my shares. Wow, what a great deal. I mean, if you think like this, then it's very wrong. And a lot of students do it like this. I don't know that. Where have they studied from? They do this and then say that the institute has made a mistake. Please get it corrected. The institute doesn't do that, so this is wrong. Institute is correct. You're doing it wrong. NPA is a negative parameter. Tell me, for NPA, is it better if it's higher or is it better if it's lower? It's better if it's lower. Do you know what you were doing? The target company is in a worse state than mine. My NPA is 5. The other bank's NPA is 20. Alright, out of 100 of its loan, 20 are non-performing. My 100, only 5 non-performing. It means that company is in worse state than mine. And still I would issue 4 of my shares for one of their shares. It's really good. Just think about it logically. See, there are no formulas in this chapter. You just have to apply logic. Alright, so if it's a negative parameter, you have to invert the formula. That is our logical formula, which is not derived from anywhere. So you place the acquirer's parameter in the numerator and the targets in the denominator. This yields the exchange ratio for negative parameters. What is acquirer's NPA? You have to put that first. And that of target is 20. So what do we get? 1:4 means for every 4 shares of target company, I am going to issue 1 of my shares. So the person who holds 4 shares of the target company will get 1 share of my company at the time of the merger. It's absolutely correct. This is how it should be. That company is in worse state than mine. Its NPA is 4 times higher than mine. So this should be the case. Has the concept become clear now? You will never have any problem with this question. See, is this point clear to you? I have written note in this. Look at it. If the exchange ratio is to be calculated using more than one parameter, then the weighted exchange ratio is calculated by applying the weights to each exchange ratio arrived at using a parameter. How will you calculate the exchange ratio? ER1 into weight 1 plus exchange ratio 2 into weight 2 plus so on until exchange ratio n into weight n. What does this mean? It is simple. Sometimes the question will tell you to calculate the exchange ratio based on multiple parameters. Calculate exchange ratio using following parameters. Suppose it says EPS, MPS and BVPS. You have to calculate the exchange ratio using these 3 parameters. Sir, how to use all 3? You can calculate based on EPS, MPS or BVPS. How to use all three? In such a case, it will also provide the weights. It provides all three parameters and their weights. If the question states to calculate the exchange ratio using multiple parameters, it will provide the parameters and their weights. For example, if it specifies calculating with 3 parameters, it will include their weights in the question. Then you know what you have to do? Calculate exchange ratios using all 3 parameters. You know the weights for all 3, multiply the exchange ratios with their respective weights to find the final weighted average exchange ratio. That will be final exchange ratio that you have to use. Look at the example. You are given the data. Acquirer and target. Their EPS, MPS, BVPS. All are positive parameters. The exchange ratio is calculated using EPS, MPS and BVPS by dividing the target's parameter by the acquirers. The weights for all 3 including EPS, MPS and BVPS were then applied. This is the final weighted exchange ratio and this is what you have to use here. What is this 0.76? Means for 1 share of target company, I will issue 0.76 of my shares. You will find this in questions. What do you have to do? It is just simple calculation. Calculate weighted exchange ratio for multiple parameters. This was the example I gave and explained. So the first step is to find the exchange ratio. The exchange ratio will be given in the question or you can find it. I have explained how. Now step number 2. Knowing the exchange ratio, it becomes easy for target company shareholders. How many equity shares will acquirer issue? So how do we get number of equity shares of acquirer company to be issued to shareholders of target company? It's very easy, NT into ER. But should we write this formula in the exam? No. You don't have to write any formula from this chapter. Let me clarify again. Listen carefully. You won't find these formulas elsewhere. I created them for you. Once you read these notes and listen the video, you will like this chapter. It has been prepared for you properly. In the structure, you have written abbreviations. I said listen carefully, remember their meanings as they will be used. ER meant exchange ratio. So what does NT mean? N means the number of equity shares outstanding. What are number of outstanding shares in company? T means number of equity shares which are outstanding in the target company. T means target company. How many shares were outstanding in the target company pre-merger? This is about the individual target pre-merger. Target company exists pre-merger, it won't exist post-merger. Alright, it will be merged into me. How many equity shares in the target company pre-merger multiplied by the exchange ratio? Remember its meaning, avoid confusion. NT into ER should be clear. Don't write it in the exam, just perform direct calculations. As I told you in the example, the shareholders of the target company have 1 lakh shares. That's what it has issued in market. I will issue 0.80 of my shares for theirs. For 1 lakh, how many will I issue? 1 lakh into 0.80, which is 80,000 shares. How much? 1 lakh, which is NT. 0.80, which is the exchange ratio, so NT into ER. There is no doubt about this. Let's move on. There are some notes in this topic, pay attention to them. Look in this note number 1. Sometimes the question which we will have, amount of consideration will be given in question. How much consideration will be given to shareholders of target company? The question sometimes provides the consideration to be discharged to target company shareholders. The consideration amount will be provided in the question. So if the amount of consideration is given in the question, what does it mean? Suppose in the question, you are clearly told that the target company's shareholders are to be given a total consideration of rupees 40 lakh. So isn't this a cash offer then? No, don't bring cash offer into this. I must give 40 lakh rupees consideration. But how? By issuing my company shares. So in this case, how will we calculate the total equity shares to be issued? It's easy, number of equity shares of acquirer company to be issued to shareholders of target company. What do you need to do here is take amount of consideration given in question, divided by MPS of A. Now you should know the abbreviations. MPS of A means market price per share. Of A means acquirer company. T means target, A means acquirer. Now remember this. Look at market price per share of acquirer company. What is pre-merger? It's a simple matter. Look at our example. It's written in the question for the other party that you have to give a consideration of 40 lakh rupees. I have to give a consideration of 40 lakh to the other party. How should I give it? By issuing shares of my company. So sir, 40 lakh rupees. Giving these shares means shares worth 40 lakh rupees. What is my shares worth? Sir, one of my shares is rupees 50. So the acquirer's market. If you divide by that, will you get 80,000 shares? These are basic things. There was nothing special in this, tell me. While this point might appear in a few questions, generally all questions will be about the exchange ratio, and I will show you this as we revise the concept now. Those we did in our regular lectures, you must remember, those who attended the lectures. Okay. I've explained how number of shares will be issued in this scenario. After this, if we need to calculate exchange ratio in this scenario, then what's the need for it? Exchange ratio is used to find out how many shares to issue. It won't be needed much, but whenever question on mergers comes, question doesn't just ask one part. Institute asks 4 to 5 things in the question. Because these are small parts, many questions are mixed in it and many topics also come mixed together. If needed in a future part, suppose it was asked first, we calculated it. In the next part of the question, suppose you are going to need the exchange ratio. When the exchange ratio is unknown, how is it then calculated? It's simple. How's exchange ratio calculated? How did we calculate the shares issued in the exchange ratio? Number of shares outstanding in target into exchange ratio. So to find exchange ratio, what do we do? Number of shares issued to target. NT is multiplied, then it goes into division. Divide by number of shares outstanding in target. Number of equity shares issued to shareholders of target divided by number of equity shares outstanding in target pre-merger. How many were outstanding? Logically do it. Target's 1 lakh shares outstanding. How many shares am I to issue them? 80,000. For their 1 lakh shares, I will issue 80,000 of mine. This is the exchange ratio showing how many shares for the target shares. You can remember logically. This was 0.80. Okay. So this is the kind of. If such a case arises, calculate this way. Look at the second note. Calculation of number of equity shares outstanding in the merged entity. How many outstanding shares will actually be there in the merged entity that is formed? This is a very important point. Please look carefully at it. See the entity that will be merged. IMA Limited, the acquirer, and Reliance Limited is the target. I am buying it and merging it into my company. This is the basic concept for this chapter. I've explained that once merged, it will no longer run separately. We become the merged entity. The merged entity is A Limited. As A Limited, which is merging in the other company into mine, it will simply expand my scope and the merged entity will always be the acquirer. The acquirer becomes the merged entity. After buying the other company, the acquirer simply expands its scope and it is not a new company. Remember this point will remain fixed in this chapter. If you want to understand concept for decision making in chapter, you will always have to proceed with this same thought process. Normally, I will give you another example. This is the general example which I gave in the regular lecture. Let's suppose that you order a cake from any bakery. So in that cake, sometimes you might add cherries on top or you could bring some fresh fruits and add them on top. But the foundational base of the cake always remains the same. You add some different things on top of it. You still call it a cake, right? It remains a cake. You can merge anything else on top of it. So it's the same thing with a limited, a company. A limited is a company. All right, this company. What did this company do? It bought the other company, Reliance Limited, and merged it into itself. It merged it into itself. Look, it bought Reliance and merged it into itself. So it is still A Limited, right? It's just that now after the merger, you will call this A Limited a merged entity. After the merger, A Limited will be called a merged entity, but its name remains A Limited. Well, A Limited is always the core base entity. I am focusing on this word again and again because it is the most important thought process that you should have in your mind to solve the questions of this chapter. If this thought process is clear, the question will never be wrong. Remember, A Limited itself truly becomes the merged entity after the merger, simply expanding its scope and level. How do you calculate outstanding shares in the merged entity? Now I have written a formula here, but you do not need to write these formulas. No formula exists and it's logical. NAT, N means number of equity shares outstanding. AT means when these two words come together, it refers to the merged entity. When word AT comes, keep this abbreviation fixed in your mind. When the word AT comes, it refers to merged entity and NAT means number of equity shares outstanding of merged entity. How many outstanding shares are there in the merged entity? How will we get that? NA plus NT into ER. What does NA mean? N means number of equity shares outstanding. A means acquirer. Equity shares outstanding in acquirer pre-merger. Well, when a single word comes A or T, it will refer to pre-merger. And when AT comes together in our notes, this refers to the merged entity. Keep it clear. You should take the acquirer's pre-merger shares plus NT into ER, which means target shares into ER, which means how many shares of our acquirer were issued to the target. How did this come? It's very easy. Listen carefully. Merged entity is the acquirer. I, the acquirer, merged the other company. I have become merged entity. We are the acquirer. The base entity was always the acquirer. So the shares that the acquirer had issued in the market pre-merger, its own shares, which we are calling NI. Those shares will remain in the merged entity untouched and will continue as before. That's why NA is as it is. But for the merger, the acquirer has issued some shares to the target company, to the shareholders of the target company. It has issued some shares to the shareholders of the target company. The shares are being issued to target shareholders. These shares are issued by whom? The acquirer, and they will then be part of the merged entity's issued capital. This will also be there. The merged entity's total outstanding shares are determined as NA plus NTER. Don't directly add the target shares here. Only the shares the acquirer issued to the target are included. That were shares in merged entity. The acquirer issued them. Acquirer itself becomes merged entity. Is it clear? Some people use a completely different logic, whose basics of merger and acquisition are never clear. Let me tell you one point. Some people think that acquirer issues the shares to other company. We are issuing shares to the target company. But that kind of thinking is incorrect. You give the consideration to the owners and to the shareholders. They will take it, not the company. And some think shares are issued to the company and its shares transfer as it is, leading to illogical arguments. Nothing like that happens. You issued shares to shareholders of other company. Shareholders now have an investment and the company receives nothing since it is finished. Clear? This point should be clear in your mind. So this is an 80 after this look. Sometimes the question will ask you to tell the promoter's holding percentage in the merged entity. What will be that percentage? It's very easy. We calculate promoter holding percentage using basic principles. Number of promoter equity shares divided by total shares outstanding multiplied by 100. So look, multiply by 100 as it is. What comes in the denominator? The number of equity shares outstanding in the company. For the merged entity, how to calculate the promoter's holding percentage? Outstanding shares in the merged entity are called NAT. These abbreviations will be quite important. Remember them, they won't be repeated. NAT divided by. In the denominator, what do we need in numerator? How many shares do promoters have? How many have promoters held? Promoters' shareholding is calculated in two parts. One is the acquirer company. The promoters must have held some shares in that particular company. Its promoters must have held shares pre-merger, and those shares remain in the merged entity as the acquirer's market issued shares remained untouched. Remember this. Look at our example. Let's assume the acquirer had issued 1 lakh shares in the market. Pre-merger, if you remember our example, let's say 50% of shares were with promoters. How many shares did promoters have in acquirer? 50,000. So sir, those 1 lakh shares have come into the new entity as outstanding shares because the acquirer's shares were not tampered with. The 50,000 shares that the promoters already held remained untouched. First, the equity shares held by the acquirer's promoters plus. After this, we have also issued our company's shares directly to the shareholders of the target company. Look, when you issue shares, when you buy the other company, then we will issue shares to all the shareholders. We acquire the company by issuing shares to all shareholders. Are you a promoter or non-promoter? So the target company's shareholders had both promoters and non-promoters, and I simply issued my shares to all of them, to everyone. Alright, I issued shares to everyone. In the target company, out of 1 lakh Reliance Limited shares, 60,000 were with its promoters. The ones who had 60,000 shares, how many shares of my company would I have issued to them? 60,000 into 0.8, the exchange ratio equals 48,000 shares. So sir, to the promoters of the target company, how many shares did I, the acquirer, issue to the promoters of the target company? 48,000 shares. I took their 60,000 shares. According to the 0.8 exchange ratio, they would also have been issued 48,000 shares. I issued those shares, and after the merger, how many shares did promoters have? Acquirers' promoters held their shares. The target's promoters had 48,000. Well, they are also promoters, right? We were asked about promoters. They are promoters from the target. So how many shares were issued to them after the merger? You have to see that because in the merged entity, we will take the issued shares. What merged entity did? We're talking about merged entity. How many shares will promoters have in merged entity? In the merged entity, promoter shares will equal those held by acquirer promoters plus the shares issued to target company promoters. Multiply the target's pre-merger promoter shares by the exchange ratio using the normal method. Divide by the merged entity's NAT and multiply by 100. It's complete. With this topic is complete number of equity shares to be issued. This topic was still a bit of a point for you to understand, where you had to use your brain a little, understand and give time. Once this topic is understood, the things ahead will just go on in a normal way. They won't take much time. Look ahead now. Next topic, post-merger book value or book value after merger. Look, now I am buying the other company. I am giving it consideration by issuing shares of my company. In this case, now I want to check what my company's book value will be after the merger. That is the book value of the merged entity. Post-merger book value means the book value after the merger. Whenever we speak of after the merger, you must understand that we mean the merged entity and only it will remain. I was acquirer. I bought other company, merged it into myself and raised my level. After that, I calling myself merged entity. The acquirer is the base entity expanding its level and calling itself the merged entity. What will be book value after merger? That is, what will be book value of merged entity? We want to see this. This topic sees few questions, but the institute includes it. I have explained it, so do not over focus, just listen. Because this is in very few questions, but students are not able to solve those few questions because their topics are not clear. They have a cramming habit, just watch YouTube solutions and go. If tricky questions appear, then they start calling the paper tough. They have developed this habit. What to do then? The solution for that is to start studying the concepts. So post-merger book value. Calculate post-merger book value. You must understand the meaning of book value first. Remember that post-merger book value signifies the merged entity's book value. From your AFM Basics, I have told you that book value means net worth and shareholders' funds. All these words have the same meaning. It is share capital plus reserves and surplus. Share capital plus reserves and surplus. That's your book value. If preliminary expenses are showing up in the balance sheet, you have to deduct them. Note that while they don't exist today, if given, you must still deduct them. It will appear in a bank question and you must deduct that from there. You all have to remember this. Otherwise, you calculate book value this way, a basic formula. Now look at the book value. Share capital plus reserves. This is formula for book value. What will be book value? And the merged entity's share capital will be the number of shares multiplied by face value. What is share capital in books? In this topic, you should link it to accounting. I will also link it. You will understand this topic is linked to accounting. Understood through accounting, book value is an accounting topic. Share capital is shown at its face value and the outstanding shares are multiplied by their face value. In the merged entity, the number of outstanding shares is an AT, representing total shares outstanding, into face value per share. Now we have to take face value of one share. Merged entity. Merged entity means acquirer. Acquirer company is merged entity. Acquirer expanded its scope. I was repeating this point in previous section. Otherwise, you will not grasp this chapter. I was saying from beginning, keep it clear. Acquirer buys other company, merges it into itself and raises its level. In the merged entity, the base is the acquirer and its face value will be the merged entity's face value. The merged entity's share capital is an AT into acquirer's face value per share. Plus reserves. The acquirer's reserves will just remain. Acquirer's reserves remain as it is. Remember accounting. You must recall some accounting for a moment, and at the time of merger amalgamation, what did you used to do? When you did consolidation, the acquirer its own data. It would take its own data in the balance sheet as it is, its own share capital, reserves and surplus, everything. Plus we would take over all their assets, liabilities and also the net assets. The acquirer will take its own reserves as it is. The acquirer entity becomes the merged entity and its reserves now belong to the merged entity. Target's reserves should be taken following acquisition. Yet while memorizing, students make a mistake. You can't just directly take the target's reserves. Do you remember ever taking the target's reserves? In accounting, you don't just take over the other company's reserves like that. Let's recall the accounting treatment you used for this. Now you might very well be thinking about accounting concepts such as common control or the pooling of interest method. I'll avoid exceptions, focusing on the general scenario. If you get lost in exceptions, it won't help. The way to think here is from a normal scenario perspective. Just see. Let me remind you of some accounting. What entry did you pass? You would record the net assets taken over, the assets of the other company, debit assets and credit liabilities, debiting net assets. We don't have to do full accounting here, just understand this logic. After this, we would pay them through a share offer, so we used to issue share capital. We credited to equity share capital. The amount is shares issued multiplied by face value, and equity share capital is always booked at face value in accounting. Shares issued NT multiplied by year. The acquirer is issuing these shares, so their face value applies since accounting occurs in my books. So face value of acquirer. NT into year, number of shares issued multiplied by acquirer's face value. This gives share capital amount. Alright. So we took over the net assets and also paid the consideration with the equity share capital. Difference was our capital reserve. You'll get capital reserve. You might say we also used to get goodwill on debit side. We will simply call it the capital reserve as we're not doing the full accounting for the exact difference. And why isn't it coming up? You might think that to securities premium should also be here. Share capital. Market price higher, account for securities premium, then calculate goodwill or capital reserve. My friend, that's accounting. Financial management focuses on decision making, not absolute accuracy. Calculating securities premium also adds to total reserves, which is our focus. Consider it as common. I'm taking it as capital reserve. This difference between the two will be called capital reserve. It will always be a capital reserve. Even if it's negative, you call it a negative capital reserve. It won't be negative because share capital is at face value, securities premium isn't included. Otherwise, it joins reserves and total reserves are the same. That's all there is to it, ultimately for decision-making purposes. This means when you acquire another company, a capital reserve arises from that acquisition. Capital reserve. It arises from the net assets. What did you give to the other company in share capital? What was the value of the shares that you gave? How do you calculate the net assets taken over from the other company, and how are net assets calculated? Net assets taken over means total assets minus total liabilities. That's what it is for you. Total assets minus total liabilities, that's book value. Remember, from AFM Basics, we have another way to calculate it. You can use share capital plus reserves and surplus, or total assets, total liabilities, identical. This means you should just take the book value of the target company. And what do you subtract from that? The value of the shares we issued. That is NTER, how many shares were issued. Multiply by face value per share of acquirer. This is share capital. You will get capital reserve post acquisition. Total reserves for the merged entity are the acquirer's reserves plus capital reserve from target acquisition. What will be capital reserve by acquiring target company? This is the total book value after the merger, meaning the book value of the merged entity. Next, let's examine post-merger book value per share, or BVPS. You must calculate the post-merger book value per share for the merged entity, simply calculating BVPS. BVPS 80, 80 stands for merged entity. BVPS 80 means post-merger BVPS, that's BVPS of merged entity. Get this abbreviation fixed in your mind. How do we calculate it? Do you know how to calculate BVPS? Just go back to basics of AFM. Everything is there. I've told you there's only few new things in this chapter. The rest of it is all basic stuff that we've already covered in previous chapters. The BVPS is found by dividing the total book value by the outstanding shares. To calculate the merged entity, take the total post-merger book value divided by the number of shares outstanding in the merged entity, NAT. Was that difficult? No, this is very easy chapter. It is the easiest in your entire syllabus. You'll get free marks if you do this correctly. However, if you just memorize questions from YouTube, then it will be over for you. Nothing can be done. Syllabus will always feel tough. CA final will seem hardest exam, and that struggle will continue through life. It's the repeating cycle. Look at the next topic. Post-merger earnings or earnings after merging. Like book value, what will be book value of company post-merger? What will be the company's earnings after merger? Meaning, what will merged entities' earnings be? Now, what precise amount of earnings will the combined merged entity truly generate for its equity shareholders? So we calculate these post-merger earnings. What earnings will the merged entity generate for its equity shareholders? It's very easy. How will you calculate it? It's simple. Look first the acquirer. It generated earnings for its equity shareholders, the acquirer's pre-merger earning available to equity shareholders. We will denote this figure as EA. The target company generated earnings for its equity shareholders, which we will denote by EAT, ESH of the target company pre-merger as ET, E and ET. Don't memorize formulas. I've placed abbreviations in the revision notes. Just do direct calculations for the exam. No exact formulas for these even exist. Now others will certainly start copying these techniques, which many do. They have already done it. Now they will do it even better. So look what happens here. It's very simple. Acquirer was generating earnings for equity shareholders. The acquirer then took the other company, Reliance, and merged it after acquisition. Because of the merger, the earnings will derive from Reliance's capability, those being the earnings which Reliance was generating. The merged entity also generates those earnings for equity shareholders. Now what will the merged entity generate for its equity shareholders? Earnings. The earnings that the acquirer was generating will definitely come. The earnings Reliance was generating for its shareholders will also come, and total both these earnings. The merged entity's earnings for its equity shareholders, you will call it EAT. EAT means the post-merger earnings. Merged entity's earnings available for equity shareholders. How much will the merged entity earn for equity shareholders? That is EA plus ET, meaning the acquirer's EATSH and the target's EATSH pre-merger. It's simple matter. In the example that we just discussed, if you calculate on the basis of EPS, then the acquirer was generating total earnings of 5 lakhs. Target company generated 3 lakhs earnings for shareholders. How to calculate earning available to equity shareholders? I explained it in basics. Subtract preference dividend from profit after tax and get it. But you will never find preference shares in questions. It's profit after tax. Becomes the profit for equity shareholders. I've stated this. So both these earnings were being earned by the two companies for their respective shareholders. Now when the companies merged, the merged entity will generate these total earnings, so it will generate this. Additionally, this formula includes plus synergy in earnings. Plus synergy in earnings is one extra thing. If the question gives this, you have to consider it. The question might state when the company merges post-acquisition. There will be a synergy of rupees 2 lakh in earnings, meaning the earnings will increase by rupees 2 lakh. What is this? See, when I buy the other company and merge it into my own, I get some synergy benefits because of buying and merging that company. Benefits means suppose we are both companies in the same field. Previously that company marketed separately and I did too. Now having bought and merged it, marketing efforts will be consolidated and done only once. The marketing cost is reduced. It had its own separate staff for accounting, and let's say I had my separate staff. Now that I've bought it and merged it, I will have a common staff, right? I will cut that unnecessary cost. Suppose I bought that company. Buying them will bring significant growth and our overall brand value will naturally increase, leading to higher future earnings. Because now more customers will come. People will see this company has become so big, let's buy its product. Synergy can be found in earnings, and if question gives it, you have to consider it. Don't assume it on your own that we have assumed this much synergy in earnings. The institute also assumes it zero. Don't make any assumptions. If synergy in earnings is mentioned, consider it, else nothing. Add acquirer and target earnings. You have been asked for post-merger EPS. What is the merged entity's EPS? Post-merger earning per share. Formula for EPS in basics of AFM: earning available to equity shareholders divided by number of shares outstanding. What is post-merger EPS called? It is EPS-AT, the merged entities. Merged entities' earnings are available to the equity shareholders. Divide by the total outstanding shares of the merged entity, NAT. I mean, the rest is over. This is the topic on which really tough questions come in the exam, which I have taught you here. Look at the next topic. Post-merger market value, or the value after merger, you can call it. What will be market value of company that is formed after merger? Market value of merged entity. We talked about book value of merged entity and about earnings of merged entity. Now we will talk about market value of merged entity. What will be the market value, which is also called market capitalization, and whether it's market capitalization or market value, it means the total market value of the merged entity's shares. We want to do these calculations. What will happen? In the same way, the pattern we are studying on right now. Now look at one point. I want to make you notice one thing. When we discussed the post-merger book value, we first looked at the total and then per share. When we talk about post-merger earnings, first we look at the total post-merger earnings, then we went into the cost. But when we talk about post-merger market value, first we will have to calculate the post-merger market price per share. First calculate the post-merger MPS, meaning the market price per share of the merged entity. Then calculate the post-merger total market value. This is vital for the exam. The pattern that the institute follows, I teach you things in that same pattern, and the institute follows this pattern. If you first calculate the post-merger market value, that is also possible. Rounding causes a potential difference. What I teach is full and final, and with that everything will match. All the solutions have been done in the class. So those who have attended the class have written everything. So you have to follow this. Now before I start teaching you this, let me tell you one more thing. When I am teaching this topic, listen carefully. Because of this topic, maximum 99% of children have doubts. In this chapter, they call the institute's question wrong. They say that the institute's question is wrong. They don't know how to frame questions. They haven't studied this topic properly because of that. They just memorize questions on YouTube videos. Calling them God for doing questions is wrong. They are just wasting your time. They are fooling you by not knowing the concept. If you study this topic properly, no question mistakes. You will understand, okay, this is why this was done in this question. You will get complete clarity here. Look, what is that clarity? Listen carefully. You must calculate the post-merger market price per share, the MPS. This calculation comes first. So if you have to calculate the post-merger MPS, you will have two scenarios. Post-merger MPS is calculated two ways. Two ways and two scenarios, keep that in mind. One scenario is the PE ratio of the merged entity is given in the question. The PE ratio of the new entity that will be formed after the merger is given in the question. Second scenario, merged entity PE ratio is not given. In both scenarios, method of calculating market price per share is completely different and answer will also change. It may coincidentally be same, that's different matter, otherwise the answer changes. Therefore, the question is declared wrong because we don't even notice all this and we don't have that habit of studying conceptually. So look, first scenario is that if the PE ratio of the merged entity is specifically given in the question itself, calculating the post-merger market price is easy. MPSET, look, I told you during the basics of AFM. PE ratio is MPS by EPS, and to calculate MPS, how is it done? EPS into PE ratio. This will be the formula, right? EPS into PE ratio. To calculate MPS, we will do EPS into PE ratio. This is the formula that is made. Merged entity MPS is calculated as MPS into ET. How will it come? EPS of merged entity, that is EPS 80 into PE ratio of the merged entity. It's that easy. These are free marks. Understand its calculation. If the merged entity's PE ratio is given, this method applies. You can use. The PE ratio of the merged entity is given in the question. How will we find it and how will we know? The question will state it. The entity formed after the merger, its PE ratio will be 10. It will be written in the question. The expected PE ratio of the merged entity is 9. Understand the PE ratio is given. Don't use your brain, just apply this formula. Or it can be said in another way, and in most questions you will find this way. I will also demonstrate how this particular line appears in the question, which we noticed in our regular class. What line will we find? The acquirer's PE ratio will remain unchanged after the merger. PE ratio of acquirer will remain same after acquisition. That the PE ratio of the acquirer will remain unchanged. You find this kind of wording in question. What does this actually mean now? If I translate these words, the acquirer's PE ratio will continue unchanged after the merger process, or the acquirer's PE ratio will remain the same after the merger. Acquirer's PE ratio will remain same after acquisition, merger, acquisition, all are same thing. This implies that the acquirer's PE ratio will remain constant after the merger if such phrasing is stated in the question. This implies that the acquirer's PE ratio is the same as the merged entity's PE ratio. The acquirer also becomes the merged entity post-merger, a point I've explained from the beginning. I had repeatedly emphasized this basic point and you must remember it. If someone does not have this point in their mind, I explained that the acquirer fully absorbs the other company into itself and it then ceases separate operation. And the acquirer's level and overall scope increases. The base company remains the acquirer, but its level or scope increase. I have been saying this again. If this thought process is clear in your mind in this chapter, then you will never make a single question wrong, no matter how new the question is in the exam. Understood? So the acquirer's PE ratio is going to continue after the merger. Acquirer's PE ratio remains unchanged post-merger, and this provides the merged entity's PE ratio. After the merger, the acquirer's PE ratio indicates the acquirer becomes the merged entity, and this will be the merged entity's PE ratio. So the acquirer's pre-merger PE ratio becomes the merged entity's PE ratio. Got it. So you will find this line in most of the questions. You will calculate MPS 80. Now you should not have any trouble in any question. If you make a mistake, it's your responsibility, we can't help. This point is complete. It was very easy. There was no problem in it. The second scenario. If the PE ratio of the merged entity is not given in the question, it's not given. Let me tell you, this scenario is applicable for 4 or 5 questions. In other questions, this scenario is applicable. This is only in few questions. Otherwise, this one is applicable in all other questions. This is also easy if you understand it. Otherwise, this was quite normal and simple. Look, this question applies in certain scenarios. How? You will discover that in the question only. Often the merged entity PE ratio isn't given. So in such questions, should we assume that acquirers will continue? Avoid the assumptions, as the question does not state the entity's PE ratio. And nor the question has said that the acquirer's PE ratio will continue or the acquirer's PE ratio will remain unchanged or same after the merger. Nothing like that has been said. Don't assume on your own that acquirer's PE ratio will remain same. Don't write that line and assume that PE ratio of merged entity is equal to acquirer's. No. Don't do anything on your own. If the question says so, it's because it wants to tell you the PE ratio of the marginality. Okay. If the question doesn't say anything, not a single word about the PE ratio of the merged entity, do not make any assumptions. You will calculate the MPS in the normal way. So how will you calculate it? Now your approach will be somewhat different. What do you have to think? Now your thought process is a little bit more advanced. The way of thinking is little different. Now what will be the way? And in your case of earnings, the method used in the case of earnings, what will it be? Let's say, so A Limited acquired and then merged Reliance Limited into my company. So I bought it and merged it. So after the merger, what will be the total market value of the merged entity? The acquirer's pre-merger market value will become part of the merged entity. Target company will bring pre-merger market value to merged entity, VA plus VT. What are these total post-merger earnings? The earnings the acquirer generated for its shareholders and those the target generated will be the total post-merger earnings for the merged entity. This same approach applies here. What was the pre-merger market capitalization of this acquirer? Plus what was the pre-merger market capitalization of the target? Now this process should come to mind. This was the market value of the acquirer pre-merger. This was the pre-merger total market value. You know this means market capitalization and MPS. Number of shares, acquirers pre-merger shares multiplied by MPS. Targets pre-merger shares into MPS. So we will get the pre-merger market value of both companies. Well, when both companies merge, we will assume that the market value of both companies will also be totaled. Both companies' market values will be totaled, we assume. If PE ratio not given. Thus it is VA plus VT. VA means market capitalization of acquirer and VT means market capitalization of target pre-merger. Ignore other things which are written ahead for now. Listen to what I'm saying. There are detailed things in them. Plus synergy in market value if any is given in the question. The question said that both companies merged. Both companies merged, I acquired it and merged it. So there will be synergy in the market value. The market value will increase by 10 lakh rupees. Synergy in market value. Consider that. The total pre-merger value of both companies plus this synergy will be the total market value of the merged firm. Divide by the number of shares outstanding of the merged firm NAT. So it will be MPS 80. Total market value of the merged firm divided by its number of shares yields the market price. How was merged firm's market value calculated? VA plus VT plus synergy. VA is pre-merger market cap of the acquirer. VT means pre-merger market capitalization. What does synergy in market value mean? PV of future gains or savings. The question can give it like this, that if you do the PV of future gains, then this amount is formed. This means it is synergy in market value. The question implies it indirectly. It's given in some questions. I will show you when revising. If the PV of future gains or savings is given, this represents synergy in market value and it is logical. I have told you that every year savings will result from the merger. When you PV future savings, you get the value. We have studied this completely in the valuation chapter. Studied valuation. So you get the value by doing PV of future earnings. Now the savings that will happen in the future. The increase in earnings, the change and also the gain in earnings. If you do its PV, you get the increased market value synergy. Understood? Because the future savings are what will increase the market value. That's why the market value is increasing. Is that clear? So this will be MPS 80. It's normal. Now let's talk about this in more detail, which is written in the brackets. In the regular lecture, I had explained this very point to you a little later during the questions. But this could be a mix-up. But as revision is going on, I will discuss this with you here and listen carefully because I might go into detail. It's point of discussion. Look, what did I tell you in this? If your PE ratio is unavailable, then you will take VA VT plus synergy in market value. This will be total market value divided by number of shares. Then MPS 80 will come. Now let's talk about VA and VT here. Recall our discussion on pre-merger market capitalization for both companies. Now listen closely. Suppose the target company, the other company. A method to calculate its value is given in the question. The ones I have taught in valuation, business valuation. I had taught methods of valuation in business valuation. Why are you doing valuation? Because for purpose of merger and acquisition, we need the value of that company's share, how much the share is worth, so that we can take a decision whether to do merger and acquisition or not. Do you remember? I have been linking everything chapter wise. I will teach according to that only. A method to find the value of the target company's share is provided to you. Usually the question provides the dividend growth formula method for mergers. So a method is given for the target company's shares that if you do a merger, then this company will have this much growth. So you calculate the value of that company using the dividend growth formula. You know what VT you will take in that case? Don't take pre-merger market value. Use the calculated value from the valuation approach which is given in the question. Use the value that came from that method. For VT, you should take the calculated value from the valuation approach and keep this in mind. A question will come. I'll show you why this was specifically done. So in VT, you will take the pre-merger market value if it is available. But if you are given a calculated value, any valuation approach, a valuation method in the question, and from that you can find the value of that company, then take that value. Similarly, in the case of VA, you will take the acquirer's pre-merger market value. But if method is given to find the value of acquirer, valuation approach 1, then after finding that value, the value that came, you will take that in VA. Keep this in mind. Why are we doing this? Look, the value that genuinely comes from the valuation approach, and in that we clearly assume that the merger, what should its post-merger value be? We calculate this company's value for merger, and I taught this in business valuation. After taking effect of merger, this growth will come. We are calculating value accordingly. So this value that came is generally in case of VT. If the other company is merged, it will have growth and we calculate its value. This then becomes the company's post-merger value. So in this VT, synergy has already come automatically. In a question like this, the amount of synergy in market value will not be given separately. That's why we call the question wrong, because we don't know these concepts, these subtle concepts. I will revise this with more clarity at the time of the question. I am saying this for those who have not seen my regular lectures. Keep this in mind. At the time of the question, I will link them better. For now, let's move forward. In 2 or 3 questions, I will link this. Now look. We learned to calculate post-merger MPS if P ratio is given, then EPS AT into P ratio of merged entity. If not, VA plus VT plus synergy in market value divided by an AT. We must calculate post-merger market value or market capitalization for the merged entity. You will say VAT. What is V? Post-merger market value, market capitalization. AT means merged entity. Post-merger market capitalization or value of merged entity is VAT. How will it come? What was market capitalization? MPS into number of shares. Merged entities, MPS into number of shares of merged entity. It's easy. Keep the abbreviation in mind and there will be no problem. I have explained everything clearly. Now we can move to the next topic. Now look, impact or effect of merger for the shareholder or gain loss to the shareholders. From merger, benefit or profit to shareholders from merger. Or are shareholders better or worse off than before the merger? Or accretion dilution due to merger? If any of these things are asked in the question, they all mean the same. I have made this heading. I have written 5 points in it. I have written their names 5 times. It's a very big heading, but the topic is very easy. It can be asked in the exam by any name. This often causes confusion. However, all these 5 things have the same meaning. What does it mean? What impact or effect will merger have on shareholders? What impact or effect will the merger have on the shareholders? That's what we want to see. So impact or effect on shareholders due to merger, meaning what gain or loss will shareholders have due to merger? What gain or loss will shareholders experience from the merger? So if it asks for gain loss to shareholders or benefit to shareholders, are shareholders better or worse than they were before the merger? This determines if their situation prior to merger improved or worsened after merger, indicating their gain or loss. Accretion means a gain or dilution indicates a loss, examining the effect of the merger. Whatever is asked among these 5, it means calculating shareholder gain or loss. It's very easy, 2 basics. There are 2 ways to calculate the gain or loss for the shareholders, and then we logically understand how to calculate it in the practice. But this gain or loss is in what thing? In what thing? There is gain or there is loss. So there are 2 bases. We will either calculate gain loss in EPS or in MPS. What gain loss in earnings did the shareholders have due to the merger? What gain loss in market price did shareholders have due to the merger? And 2 bases. Which basis we will use in the exam? I will clarify all that for you. The topic was very easy. So we are talking about gain loss for shareholders. So which company's shareholders, acquirers or targets? It should be acquirers. No. Calculate gain loss for both shareholders. Well, when you are going to merge, the acquirer company's shareholders will also see what gain loss they are going to have due to the merger. Target shareholders will also see their gain or loss from merger. You can't say what gain loss the acquirer's shareholders will have. Calculate that. You are buying the target's company and merging it into your own. So you have to think about its shareholders as well, right? When you are going to create a relationship, then in relationship, consent of both persons is necessary. One person cannot forcefully impose his own thoughts entirely onto the other party. Look, you can't have your own way completely. You have to listen to the other person equally. You have to give full and equal support to each other. We must consider the target company because its shareholders will assess the merger's impact. Their gain or loss does matter. Acquirers, shareholders only look at their own gain or loss. Shareholders of both companies will check how much gain or loss they experience due to the merger. The merger hasn't happened. If it had, then we wouldn't discuss it. How to calculate? It is simple. Based on EPS, what earnings gain or loss will acquirers shareholders have? What will be the earnings gain or loss for acquirer shareholders? What EPS were they getting before the merger? What EPS then after the merger? So what will the acquirer's shareholders get after the merger? Post-merger EPS at. The acquirer's shareholders will get same EPS as the merged entities because the number of shares the acquirer had pre-merger. The acquirer's pre-merger shares continued exactly as they were in the merged entity. They simply did not increase or decrease by even one. The earnings that the acquirers were earning pre-merger, the right they had, the same right they have in the merged entity. So post-merger, the acquirer shareholders per share earnings is EPS at. We have calculated post-luck. Minus what was the acquirer's pre-merger EPS and EPS of a meaning the acquirer's pre-merger EPS, which you already know how to calculate. Acquirer earnings divided by shares. This calculates the acquirer's shareholders gain loss per share related to their earnings. This is the gain loss per share. Multiply this and find the total gain loss to the acquirer's shareholders on the basis of earnings. Number of shares of acquirer pre-merger NA, you will get total gain loss to shareholders of acquirer. It was very easy. What was there in it? Look how easy it was. Let me show you with an example, our example. In that we had taken the acquirer's pre-merger EPS as 5. In our example, the post-merger EPS computes to 4.44. For merged entity, acquirer shareholders per share earnings in merged entity. Earlier they were earning 5 rupees per share, they were having loss of 0.56. So what is their total loss in earnings? They had 1 lakh shares, so 1 lakh into 0.56, that is a loss of 56,000 rupees. This is just the gain loss. A very easy concept. You have to strictly follow this fixed format, and remember this. You should consistently follow this fixed format. The institute calculates sometimes per share and sometimes total. By following the full method, even if it takes 10 extra seconds, you will certainly ensure your marks. This format is fixed, so always bear this in mind. No other format, nothing in your mind. Today, look at the target ones. Target shareholders merger gain or loss is calculated uniquely. What EPS were the target shareholders earning pre-merger? What will be their post-merger per share right in earnings? That will be their difference. Pre-merger, what were the target shareholders earnings and EPS? EPST, that is EPS of target pre-merger. I have written this. You can calculate this, it's generally given, or you can derive it from its earnings and number of shares. If we subtract this from post-merger EPS, we get the gain loss. Don't subtract this from EPS AT because target shareholders don't get entire post-merger EPS. Don't subtract it from EPS AT. You will have to calculate the equivalent EPS. Equivalent EPS means post-merger EPS into exchange ratio. That is EPS AT into exchange ratio. So why are we doing this? Listen carefully. It's a very logical point. Understand the concept or remember it for the exam. What is happening? The target's shareholders, what earnings were they earning on their one share? You were calling it the EPS of target. Now we want to see on one old share. They are earning some earnings. Now how much earnings are they earning in the merged entity against that one share? How much earnings are they earning in the merged entity against one old share? So in merged entity, are they getting full share against one old share? No. In the merged entity, shares which are received depend on the exchange ratio. In our case, they were getting 0.80 shares. The old one share of the merged entity was 0.80. The old shareholders, the shareholders of the target company, had 1 lakh shares of the target company. But in the merged entity, they were issued only 80,000 shares. This is what was issued. So the merged entity got 80,000 shares. So against that one old share, how much earnings will one old share generate in the new entity? We examine one old share's equivalent, hence called equivalent EPS. So EPS of the merged entity is EPS AT. This specific EPS is telling us what earnings are being received on just one share of the new merged entity. But did target's shareholders get full share in merged entity in exchange for one share? They got 0.80. So also in the earnings. How much will you get? Multiply by 0.80 means exchange ratio. That is, we want to see in comparison to one old share. In comparison to one old share, that's why it is called equivalent. Target shareholders were earning this much per share. What are their earnings per old share in the new company? They received 0.80 shares for an old share. And what is earned per new share? EPS AT is being earned, multiply by exchange ratio, they are getting this much earning. So this will be the gain loss per share to the shareholders of target. Multiply it by the target's pre-merger shares NT and you calculate the total gain loss for their shareholders based on 100. Over here, did you use target's issued shares NT into ER calculation? No. Because here we've calculated the gain or loss per share on the basis of the gain or loss on one old share. That's what we found by creating an equivalent for one old share. So multiply it by the old shares. Merger hasn't happened and we want to see what gain or loss will be on that basis. Let's use an example for more clarity. Look, target's pre-merger EPS was 3. Post-merger EPS was 4.44. But the pre-merger share had earnings of 3. Did they receive one new share? No, 0.80. This is the earning of one share of the new company. They got 0.80 in exchange for one. So that 3 was on one share. Now against that one old share, what will the earnings in the new company be? 4.44 into 0.80. This is equivalent to EPS. Understood? Then 0.55 worth of gain or loss per share. They are gaining since it's positive. Multiply this gain per share. Do you know how many old shares Target had? Their gain totals 55,000. Let me tell you, this is a gain of 55,000 and a loss of 56,000. These two will be the same amount. One will have a gain and the other a loss. But ours is different. It's because of rounding off, as we took 4.44 after rounding. Otherwise, these two would be same. Why is that? Ultimately, the total of these two will become nil. And why will that happen? Because, sir, this total. What exactly is the gain or loss in earnings for the shareholders due to the merger? The merger itself doesn't create any gain or loss. So for now, the synergy earning in our example was 0. I got this 4.44 from the 0 synergy example. If there was no earning synergy, who gets what gain or loss? If one gains, the other must lose by the exact same amount. You can verify this. But any small difference is just due to rounding. But if there is synergy in earnings, then you will see one party getting a slightly higher gain. You should notice this. Or it can also happen that this party has a nil gain or loss and so does the other. When there are no synergy earnings at all, then the total gain or loss for acquirer and target shareholders on basis of earnings, this total will become nil when you combine them. So one party lost from the merger and the other gained by an equal amount. So ultimately it became nil because we considered synergy earnings to be 0. If you look at the questions, most of them don't have synergy earnings. So if you verify, you will find the total is 0. Now let's look ahead. That was the shareholders gain or loss using EPS, and now we will move to the basis of MPS. We checked the gain or loss in EPS for earnings impact, and shareholders now want to see the market price impact from our merger. The thought process is exactly the same. First, for the acquirer, their shareholders will get MPS in the merged entity and the acquirer's shares remain unchanged. Their original share in the merged entity is now MPS. The acquirers per share market price gain or loss multiplied by their pre-merger shares results in the total gain or loss on basis of market price. MPS A means the acquirer's pre-merger MPS and MPS T means the target's pre-merger MPS. Calculate the target's gain or loss minus pre-merger MPS. What do we subtract it from? The equivalent MPS, because the target's one share had a pre-merger market price. In merged entity, one old share received 0.80 per exchange ratio. So in the merged entity, what portion of market price did they get? The post-merger MPS into exchange ratio, it's MPS into ER, is what it's compared to. Multiply targets per share gain or loss by total shares. The total gain or loss to the shareholder. Understand? This is very easy. The EPS logic also applies to MPS. They are quite similar. So we won't go into further detail now. We have discussed this in detail in our lectures, and for this revision, further discussion is not needed. This point should be clear. Now look, what about exam? What is the biggest problem in the exam? They will give topic headings and will know to calculate gain or loss. The gain or loss to calculate, is it per share or total? I said follow the format. Calculate per share and total. It's quick, makes no difference. This point must be clear. Second point, the question says calculate gain or loss. How to determine if it's EPS or MPS basis? The question will specify calculate gain or loss on EPS basis. Calculate MPS gain or loss, and then you apply this. What if question is silent asking shareholder gain or loss? What then? So you know in practical life, gain or loss uses MPS, and what's the market price impact? EPS gain loss is not as significant. Suppose you are buying a company's equity share today. Do you focus on the company's overall earnings or on its current share price? Focus on how much share price increases or decreases. The market price is important, and that's what makes a difference. In practical life, the gain or loss in market price is generally calculated. And so in a silent situation, remember this as noted. If the question asks for gain or loss to shareholders, but doesn't specify whether it's on the basis of EPS or MPS, then you have to calculate it on the basis of MPS. So if question is silent, memorize it, calculate gain or loss to shareholders on basis of MPS. This will be followed every time. You have to remember this. Now in this, don't overthink it at all. In a silent situation, just do this. After this, often the question asks for total gain from merger or acquisition, and both mean exactly the same. What is total gain from merger or acquisition? This is very simple. Calculate the total gain or loss for the acquirer's shareholders on the basis of MPS. And on the basis of MPS, calculate the total gain or loss for target shareholders. And you have to total both of them. Total gain loss to shareholder of acquirer on MPS basis, plus gain or loss for target shareholders on MPS basis. You must total this. This gives the total gain from the merger or the acquisition. In a way, it represents synergy in market value. Because of the merger, what both companies' shareholders get in terms of market price. The total gain or loss in a way will reflect synergy in market value. The synergy in market value. So that's the concept. Clear? So remember this point. If question asks, calculate accordingly. Whenever you calculate gain or loss to shareholders on basis of MPS, even in those questions, the institute often shows this calculation, so you should do it too. It will take 10 seconds to do the total. Do it only in the market value case. You calculate this market value synergy. Alright, let me link one more point to synergy in market value. The clarification I gave its detailed logic in regular lecture, but let me explain it here as well. When we talked about market price per share, you saw the second case where merged entity PE ratio was not given and market value synergy was considered. But when the merged entity PE was provided, we weren't including market value synergy, right? This is a misunderstanding. Market value synergy is considered here. We use the merged entities PE ratio. This generally means the acquirer's PE ratio will continue. Assume target's PE ratio is 8 and acquirer's 10. Merged entities total earnings are of the acquirers plus the targets. Now we will apply the PE ratio of 10 to the total earnings. The target was applying its PE ratio to its earnings and the acquirer was applying its own. Acquirer's PE ratio will apply to total earnings, thus including synergy. The acquirer's PE ratio also got applied to the target's earnings. This means that much synergy benefit has been included, so the synergy benefit is automatically included. This was explained in the regular batch, so we won't discuss it again now. This point has been explained, and then in the merger impact section, consider the third and last note. Sometimes the question asks to state the true cost of merger or net cost of acquisition or cost of takeover. This topic can be asked under any of these three names. What will be true cost of the merger? State the true cost of merger or acquisition. State the net cost or the cost of takeover. All three of these terms have the same meaning. This is calculated from the acquirer's viewpoint because they are the ones who bear the cost of buying the other company. The expense of buying is borne by the acquirer. When I buy the other company, the expense will be mine. So the cost is the acquirer's, remember that. Calculated from the acquirer's perspective, but how? Wait, the cost of the merger, does it mean how much money we gave to the other party? Is the consideration the cost? No. Pay attention to this point in this chapter. Very small words can have very different meanings. Here we are talking about true cost, net cost. Alright, not the consideration we gave. What was the net expense? What was the net expense? This is easy to calculate. I will explain first. Calculate the total gain or loss for target shareholders on basis of MPS. The total gain or loss to the target shareholders on the basis of market price. Once you clearly find that specific amount, it is then accurately called the true cost of the merger from the acquirer's point of view. The total gain or loss for the target shareholders using MPS is the true cost of the merger for the acquirer. Target shareholders gain is a cost for acquirer shareholders. If target shareholders lose, then for acquirer shareholders, the cost will be negative because it's their gain. So should this be equal to the acquirer's total gain or loss on an MPS basis? No, it cannot, as this is slightly different. Listen carefully to what it is with an example. Because you mix up a lot of things here, we won't be able to look at it in detail in this revision, but still the true cost of merger. True cost of merger means what I gave to other party, which means what did I give to other party and what did I get from them. The net of that is my expense. Okay, it's my net cost. How do you calculate net cost? Suppose that I gave him goods worth 50 rupees. Let's say I gave 50 rupees and I took goods worth 40 from him, so my net expense is 10 rupees. Because I got goods worth 40 but paid 50. So my net expense is only rupees 10. Because I paid 50 rupees but 40 rupees was for something for which I also received goods. So the extra 10 I gave is the net cost. So it's calculated with same logic. So calculate the gain of target shareholders based on MPS. The gain on MPS is the equivalent MPS given to target shareholders in the merged entity. Meaning we have given a share of this price and we have provided a stake of this price. We gave this much stake in market value. And the share of the target company that we bought, see the target company that we bought. The price of one share of that company, the pre-merger MPS is 30 in our example. And this means we gave a share valued at 35.52 for 30 rupee share. Meaning we gave them a gain of 5.52, so for me that's the net cost. because in a way I bought something worth rupees 30. I bought a company with shares worth rupees 30, so that's the company's worth. In return, I gave a share worth 35.52. I gave 5.52 extra, so this is the true cost for me, which means for the target shareholders, the total gain or loss that results. So this total gain or loss to the shareholders of the target on the basis of MPS, this total amount then becomes the true cost of the merger for the shareholders of the acquirer company. So from now, if question asks for the true cost of merger or the net cost of acquisition, don't panic. Calculate the target's total gain or loss on MPS. This topic is complete. Let's move to next topic. Next topic. This topic is completely useless. It makes no sense and has no logic, being quite baseless. Just one exam question is sometimes repeated by the institute. Otherwise, it's useless. The institute's old material is a mess. So they are just in the habit of copy pasting. They keep giving this. Just understand it once. It's fine even if you ignore it. What is the value of original shareholders? What does it mean? So the original shareholders of the acquirer and the target, how much value did they originally bring into the merged entity themselves? How much value did the acquirer's shareholders and the target shareholders originally bring into the merged entity? The value they originally brought into the merged entity is actually the original shareholder value. What does it mean? How much value did they bring? It has a simple meaning. The acquirer company and the target will combine to form merged entity. What value did the acquirers and target shareholders originally bring into the merged entity? This is the value of the original shareholders. So acquirers will bring value as VA. The acquirers and target shareholders will bring their respective pre-merger market values into the merged entity. VA plus VT. If we add synergy in a market value, this formula seems almost like the MPS 80. No, don't do that. We are trying to see how much value they brought originally themselves. So you only need to see how much value they brought themselves. Don't include synergy and all that. It's VA plus VT, the acquirer's pre-merger market value plus the target's pre-merger market value. This means you have to calculate the total value of the merged entity by simply assuming there is no synergy present in the merged entity. For the original shareholders value, assume no synergy in the merged entity, then that will be the value. Just assume this, it's VA plus VT. This totals original shareholder value. Now who has the right to this value? The total shareholders in the merged entity. So I want to calculate the value per share of the original shareholder. What is the original shareholders' stake per share? And what is their stake in per share value in the merged entity? Then divide by NAT. What is the first step if asked for value of original shareholder? You will calculate the value per share of original shareholder in merged entity. Original shareholder in the merged entity. What was the original per share value? Original value they bring is VA plus VT. NA by NAT was their stake. This is the number of shares in merged entity. Now calculate the original shareholders total value. How will you do that? Second step, separately for the acquirers and target shareholders. Focus now on the acquirers' original shareholders. How much stake are the acquirers' shareholders getting in the original value? Wouldn't acquirers' shareholders value be VA and target's VT? No, it is not. We determine the original value of the merged entity brought by the acquirer and target. The original value is VA plus VT. The merged entity is formed. In this value, what is the stake of the acquirer's shareholders and the targets? Stake of acquirer's shareholder is value per share. What is their per share stake in the original value? Acquirer's shareholders have NA shares in the merged entity. That's it. What is the total stake of target shareholders in the original value? What is the original value per share? Multiply by the target shares issued in the merged entity, NT into ER. This is a completely useless and senseless topic. It's completely worthless. Just remember it in case it ever comes up. Clear? Let me give a clarification on one point. When we study this, it comes to our mind that this formula seems like it's for the market price per share of the merged entity. After calculating, can we call it market price per share of merged entity? No, otherwise in the step 1, I wouldn't have written calculate value per share of original shareholder. Otherwise, I would have written merged entity MPS. Don't make this mistake. Suppose the question asked for the original shareholder's value and you calculated it using this step. Then it asked market price of the merged entity. After that, if you present the value from step 1 as the market price, your answer will be wrong. We learned market price calculation. You have to think that way. Whether the P ratio is given or not, calculate it that way. This is different. I have clarified this. Remember this. With this, the topic is complete. Let's move on to the next topic. Now look, Maximum exchange ratio acceptable to the acquirer company. You have to calculate the maximum exchange ratio that will be acceptable to the acquirer company. What is the maximum exchange ratio for acquirer shareholders? What does this mean? This topic is quite simple and clear. In this topic, you don't need to see anything new. And the topics we have seen so far in this chapter, we will actually be using those very same topics within this. It's actually a very easy topic if you understand it carefully. Many students get stuck on this question and they are never able to solve it. But if you understand its logic, you will never need to look at this topic again. You will be able to find the answer instantly. Let's see this topic now. What is the maximum exchange ratio acceptable to the acquiring company's shareholders to the acquirer company? This means what is the maximum exchange ratio that the acquiring company can possibly offer to the shareholders of the other company. I want to buy Reliance Limited and merge the target company into mine, so I must offer an exchange ratio to its shareholders. So in my mind, I keep a calculation ready of the maximum number of shares I can issue to them. What is the maximum number of shares of my company that I can issue? I keep this calculation ready and I will tell you why. Look, I have to buy the Reliance company. I will meet with them, and before that, I always prepare some important calculations. Why do I keep these? Suppose I have a meeting. During the meeting, its shareholder is Ambani. So I will discuss with him about buying his company and determine the basis for setting exchange ratio like EPS and MPS as discussed. So the discussion went on for a long time. Ambani got irritated and he said, I don't like your offer. I refuse to sell the company to you. Ambani said, I don't want to sell the company. I was not happy. I said that it was my childhood dream, my passion to make Reliance Limited my very own. If he doesn't sell, then passion remains unfulfilled. My ego will not be satisfied. I really have to satisfy my ego. Now in such a situation, only one thing will come to my mind. I will give Ambani a maximum offer from my side. Now I will give the maximum possible offer saying, take this is the maximum offer from me. Now sell the company. Hearing the maximum offer, he might get greedy and sell off his company. So many times at the negotiation table, you need to give a maximum offer. When you go to buy anything, let me give you a normal example. Suppose you want to buy a property, a piece of land. You might have bought one or your family might have. So then you negotiate its price with the seller, right? You negotiate the price considering the local area rates. The rates are 1 lakh rupees, 1.5 lakh rupees or 2 lakh rupees. These are the rates. Whatever the rates are, you negotiate on that basis. You quote a price and then the other person tell you how much he wants. And then at one point he said, leave it, I'm not selling the company to you. But you really like that property. So you tell him, look, I wanted to buy it for rupees 1.5 lakh per yard at a rate of rupees 150,000 per square yard. But you are not agreeing, right? So let's do one thing. Let's finalize the property at 1,60,000 per square yard. This is the maximum offer I gave him. Are there any calculation or basis for maximum offer, or did you just say it randomly? How much I can stretch? Then he gets greedy and will finally sell the company. I keep calculation ready that if I have to buy the other company, I have to issue shares to its shareholders. So what is the maximum number of my company's shares that I can offer them that I have to calculate? I will calculate this beforehand. So maximum number of shares meaning the maximum exchange ratio. What exchange ratio for each share can I give? Exchange ratio tells that. I have to calculate that. So on what basis will this be calculated? There are two bases for this. On the basis of EPS or on the basis of MPS. It will be on the exact same two bases as the gain or loss. It will be calculated on the basis of EPS and on the basis of MPS. Now what exactly are these two major bases? Now which basis should we follow? I will explain everything to you. First, let's talk about the maximum exchange ratio without dilution of EPS. The maximum exchange ratio is therefore calculated on an EPS basis. How is this calculated? Now listen to this. What does the maximum exchange ratio mean? What is the maximum number of shares I can give him? I have to buy his company. It's a matter of my ego. I have to satisfy my childhood passion. So now I have to buy the company. No matter what, I have to make this company mine. You must have faced such situations, or you might have even done it. So I have to make the other person mine. No matter what happens, I have to make them mine. What is the maximum number of shares I can give? I should give him the maximum shares such that after the merger and after buying it, I will merge it into my company after the merger. If I don't gain even 1 rupee, it's acceptable. Because now I have to satisfy my ego. I just need to buy it and merge it. It's okay if I don't get even a 1 rupee benefit from the merger. It's a simple thing. Why do we merge? Why do we buy anything? So that we can benefit from it. But now I just have to satisfy my ego, because now I am in a position to give a maximum offer. So now I just have to buy it. It's okay even if there is no gain. But remember, in such a situation, it's okay if there's no gain of even a rupee, but I should not incur a loss of even rupees 1. I mean, I want a break-even point. That is, I buy it and merge it into my company. I want a zero gain or loss per share from it. I don't even want a gain or loss. I don't want any gain or loss. This means I buy it and merge it and I won't have any gain from it. No gain is acceptable, but I should not incur any loss. Understand? If there is a logical person, if I incur a loss to satisfy my ego, then that's the worst thing. It's okay if there's no gain. At least my ego is satisfied. There was no gain, and the gain or loss per share is 0. I am at break-even point. I'm at the same situation as I was before merger. After merging Reliance Limited, my situation hasn't improved or worsened. But suppose this was my situation before. This is my situation now after following the merger. Imagine I diminished my own value to satisfy my ego, so I'm the most foolish person. And there are such people in the market today who do such things. So don't do such things. But when we talk about business, there is no such person in business. And if there is, then his company won't last long. It will shut down in a month at most. Okay? He won't be able to do business. He won't even reach the merger stage if he has such a mindset. If you want to satisfy your ego, then by break even is necessary but shouldn't be a loss. So make the gain loss per share 0. Now the logic should be clear to you. Now you should start feeling happy about this calculation. For maximum exchange ratio, per share gain or loss must be 0. Gain or loss per share is calculated two ways, on EPS or MPS basis. Maximum exchange ratio also uses these methods. Without EPS dilution. Without EPS dilution. Meaning, first, without dilution of EPS means the acquirer does not want to dilute their EPS. Without dilution of EPS means the acquirer wants to maintain their pre-merger EPS. This means the acquirer wants a 0 gain or loss per share on the basis of EPS. The acquirer wants their pre-merger EPS to be maintained in the merged entity. The acquirer wants to maintain its exact same EPS within the merged entity as before the merger. This question can be asked, for example, as what is the maximum exchange ratio without dilution of EPS? Or what is maximum exchange ratio on earnings? Or the acquirer wants to maintain EPS in the merged entity. What should be the exchange ratio? Same calculation will be done in these cases, means it's asking maximum exchange ratio on basis of EPS. This point should be clear. You should remember this. So the acquirer aims for 0 gain or loss per share based on EPS because the acquirer wants to maintain their earnings per share. They want to earn at least same per share in merged entity. It's okay if there's no gain in earnings, but shouldn't be a loss either. The acquirer wants 0 per share gain or loss. If acquirer wants to make their gain loss per share 0, then how is it calculated? EPS AT minus EPS of A. This is acquirer's gain or loss. So EPS AT, look carefully, minus EPS of A is equals to make this 0. So EPS AT minus EPS will become a plus when it goes to the other side. EPS A. We have to make EPS AT equal to EPS of A. This means you need to make the post-merger EPS equal to the acquirer's pre-merger EPS. Answer comes automatically. What you have to do is make the merged entity's EPS equal to the acquirer's pre-merger EPS. If you make post-merger EPS of entity equal to pre-merger EPS, merged entity, then the acquirer's gain or loss per share on EPS basis will be 0. So just do this and form an equation. There is no formula. A formula is written, but it will be derived from forming an equation. Now you can either remember this equation or remember it logically. I suggest remembering this once. I am explaining the logic for the exam and you can derive it logically even if you forget. Logic is the best. Formulas are not needed. Don't write derivations in exam. You calculate directly and understand the logic. Now expand the EPS AT equation because we need the exchange ratio. Let's expand this. What was the formula for EPS? Remember, it was EAT divided by NAT. Memorize it. This equals EPS of acquirer, which will be given in the question as it is. Now EAT divided by NAT equals EPS of A. This is our equation. However, we need the exchange ratio. Is it visible here? No. So now let's expand the NAT in the denominator. Expand NAT. The formula for NAT is NA plus NT into ER. Just memorize it. I'll explain basics. EAT divided by NA plus NT into ER. I expanded NAT, nothing more. Sir, the EPS of A is given. That's it. This is the final equation. Now in the exam, the acquirer's pre-merger EPS will be given or its earnings and shares will be provided. So the target entity earnings will be provided and the acquirer's shares along with the target's pre-merger shares will also be available. Calculate the exchange ratio balancing figure after filling in all data. In this formula, find the exchange ratio as a balancing figure after filling all other data. Remember this. Okay? Now one more point. Sometimes questions ask for calculations using an exchange ratio. It asks the maximum exchange ratio on an EPS basis. And some students are overly smart. exchange ratio is given in question, then I will use exchange ratio in formula. What are you calculating? We have to calculate the exchange ratio to make the EPS equal. So we have to calculate that. Don't fill it in by mistake. You all should remember this. Remember, this is the final equation. Fill all other data and calculate the exchange ratio. This topic is now completed, and what else is there? There is no topic easier than this. Concept is clear. Similarly, max exchange ratio, no MPS dilution. The acquirers shareholders want their pre-merger MPS to be maintained in the merged entity, meaning they want zero MPS gain or loss. They want their pre-merger market price to continue after the merger. They don't want any gain or loss on the basis of market price. It's okay if there's no gain, but there shouldn't be loss. It depends on them. Whether earnings affect them more or market price affects them more, they will ultimately calculate based on that. If you want to use MPS, then make the post-merger MPS, MPS 80, equal to what? Pre-merger MPS or MPS of A. Because MPS 80 minus MPS A, you have to make this 0, so just do this. Post-merger MPS equal acquirers pre-merger MPS. Now in this you have to expand the formula for post-merger MPS, but there were two formulas for MPS. What were they? When the PE ratio of the merged entity is given, EPS into merged entity PE ratio equals MPS. So how is this calculated? Exchange ratio is not visible. Expand EPS. It's EAT divided by NAT. Apply the PE ratio and MPS of A is given on the other side. The exchange ratio isn't visible, then expand NAT. EAT divided by NAT expanded is NA plus NT into ER multiplied by PE ratio, which is written as it is, equals MPS of A. I just expanded the main formula so that the exchange ratio appears. Now I will fill in all the values. The merged entity earnings, PE ratio and MPS of A will all be given. The acquirer's shares and the target's shares. Then find exchange ratio as balancing figure. If the merged entity's PE ratio is not given, VA plus VT plus synergy market value divided by NAT. This has to be made equal to MPS of A. Expand NAT's denominator and the exchange ratio becomes visible. Fill all the data. Also find balancing figure exchange ratio. How easy is this topic now? See, you have to follow this and don't ever use any other method. You can do anything in this. YouTubers provide shortcuts and different methods. Never follow those shortcuts. They might work for 2 questions but not for a new third one. Shortcuts are coincidentally applicable. I have given the reasons for these many times. You just have to solve using the fixed formula and logic I teach. Then no question will get stuck because other methods simply will not work. You won't get marks either. You will get marks here. Logic is clear and easy. Not all questions will be solved. Exams ask you the maximum exchange ratio. Calculate it without EPS dilution or MPS dilution based on the question's requirement. What if it says the acquirer wants to maintain its EPS or its same MPS? This means it's asking for the maximum exchange ratio. Calculate on that basis. Okay? So if a point says to find the maximum exchange ratio but doesn't say whether to maintain EPS or MPS, on what basis do we calculate? Nothing is mentioned. In silent situations, what basis to use? Without dilution of MPS. Silent situation, calculate maximum exchange ratio without MPS dilution. Practically gain or loss per share was MPS based. So you wouldn't want dilution in MPS either. Practically, you would think that your market price per share should be maintained. And that is the most important thing. Therefore, if silent, calculate the maximum exchange ratio without MPS dilution, and I will show you with an example. Okay, remember this. Apart from this, some people might think we calculated the maximum exchange ratio without EPS and MPS dilution. Do they differ? Yes. The ratio without EPS dilution can be different from the one without MPS dilution. It's another matter if they are the same, but generally they will be different. Remember this. And now this topic is completed, entirely finished with nothing more to cover. Next topic, which is the minimum exchange ratio acceptable to the target company. What is the minimum exchange ratio acceptable to target company's shareholders and what minimum exchange ratio will they demand? What is the minimum shares the target company's shareholders will accept? Let's say target shareholder was Ambani and I am buying Reliance Limited. So what is the minimum number of my company's shares that Ambani will demand? I will be issuing shares, right? You have to calculate what the minimum he will demand to sell his company. Now suppose Ambani is the one who needs to sell the company. Then he will come from home prepared with his calculations demanding at least this minimum exchange ratio. If the other party offers less than this, I will quote this much. Let's say the other party's minimum exchange ratio is calculated to be 0.40. I offered him 0.60 and he would say yes because his minimum was just 0.40 and he was fed up and wanted to sell. He will say okay. But let's say I gave him a quotation of 0.30. He will say, please give me at least a 0.40 exchange ratio. Only then will I be able to sell. So he comes prepared, having calculated his minimum. They will ask, what minimum? What will be the minimum? It's same method based on EPS and based on MPS without any dilution of EPS and MPS. Other party will ask for a certain minimum so that he doesn't incur a loss due to the merger. It's fine if there's no gain and he thinks similarly. He wanted zero gain or loss per share. This gain or loss on either EPS or MPS uses the same method. First, minimum exchange ratio without EPS dilution. The other party wants no gain or loss in their EPS and therefore no dilution. The target company wishes to maintain pre-merger EPS in the merged entity. The other party wants to earn the same earnings per share as before the merger. They want merged entity EPS to remain proportionate. Their goal is to have their share yield same EPS because no gain or loss in earnings per share. So how was the target's gain or loss calculated? Equivalent EPS minus pre-merger EPS. Our objective is to make it zero. Equivalent EPS must equal pre-merger EPS. Here you will do equivalent EPS equals EPS 80 times exchange ratio. What should this be equal to? Pre-merger EPS of target. The target's pre-merger EPS must equal the equivalent merged entity EPS. Remember, don't take post-merger EPS. Target shareholders don't get full post-merger EPS, only a portion based on exchange ratio. Remember this. Making them equal will result in zero gain or loss per share. We have simply multiplied the merged entity's EPS by the exchange ratio. You might say merged entity EPS times exchange ratio should equal target EPS. The exchange ratio can be directly derived and solved. We don't need to expand this formula, or do we? Why? Will the EPS of the merged entity be available? How can it be available? We're calculating maximum exchange ratio. If no ratio, no merged entity shares. How could the EPS be calculated if the shares are unknown? Do you know the mistake you make in a hurry in this question? The first part gives an exchange ratio and asks for the merged entity's EPS. The second part asks for target's minimum exchange ratio with no EPS dilution. What will you do in a rush? You'll use the EPS from the first part. That would be the biggest and most foolish mistake. First part's EPS came according to previous exchange ratio. We need a new exchange ratio. EPS and figures change, which we calculate. Never use that old merged EPS, so expand it. I wrote full equation, or else I would just explain the logic and move on. But I know you'll make that mistake because we've lost the habit of thinking critically. We don't think where it's needed, and we overthink things where it's not needed. It has become such a bad habit. EPS formula expands to EAT divided by NAT. EAT may be available, but merged entity shares are not, because exchange ratio is unknown. Expand NAT. It becomes EAT divided by NA plus NT into ER. The exchange ratio in multiplication carries forward, and we equate it to the target's EPS. Then calculate the exchange ratio. That's minimum exchange ratio. Minimum exchange ratio without MPS dilution. Target shareholders want to maintain their MPS in the merged entity. Target's equivalent MPS is merged entity MPS times exchange ratio. This must equal the target company's pre-merger MPS. To get the merged entity's MPS, there are two ways. If the PE ratio is given, we'll simply use that. EPSAT into merged entity P. This MPS multiplied by exchange ratio gives equivalent MPS, which must equal target's MPS. We will expand the merged entity's EPS, then NAT, and get the final equation. Find balancing figure exchange ratio. If merged entity PE is not given, the formula will be multiplied by exchange ratio. This is to get the equivalent MPS, and you will have to expand NAT. So you find balancing figure for exchange ratio. Now for same silent situation. If a question asks minimum exchange ratio and doesn't specify basis, calculate it on MPS. If it doesn't say minimum exchange ratio, then calculate it based on MPS. Target shareholders want to maintain their existing MPS, which I have explained. That concludes this topic, and now we move to the second and most important part of this chapter. Merger via share offer is now completed. Now I'll give you a few more points for extra clarification because we have a habit of overthinking things. Some of you might have doubts. I'll clarify them now before you ask me later. Look, I explained the acquirer's maximum exchange ratio and the target's minimum exchange ratio. The one who overthinks might ask this: why aren't we discussing the acquirer's minimum exchange ratio? And why not the maximum exchange ratio acceptable to the target? You might think I'm skipping topics. Forget skipping topics. I'm teaching you concepts you won't find in your module. You might think, is this in our syllabus? Such concept doesn't exist. I don't know where your mind is wandering. If you thought of this, let me tell you, there is no such topic. This is for those who thought of this. Such topic cannot exist. What's the minimum shares an acquirer would give to the other party? What's the minimum I would want to give? I have to buy the company, and what's the minimum consideration? I would say give me the company for free. If I have to buy something, what's the minimum I'd want to pay? I'd want it for free. I don't want to pay anything. There's no logic in even thinking about this. It's not possible. Similarly, what's the maximum number of shares the target would accept? Imagine Ambani, he would say. Ambani must decide the maximum shares he wants from the acquirer to sell his company. What's the maximum he would ask? He would say, give me as many as you can, give me an unlimited number, because who would ever refuse a windfall? If I ask him to take any amount of money, then he will take maximum. A target's maximum limit isn't valid. And something that can't exist can never be calculated. That's settled, let's move on. The third part, mergers and acquisitions by cash offer. This will have all the same topics as the share offer, and the way of thinking will be almost the same. We'll just approach it in a slightly different way. So, we won't discuss the logic in detail again. I'll just quickly help you revise it, because I'd just be repeating the same logic which we have just revised. This will now be completed very quickly. You will do merger or acquisition through cash offers. So how will your merger and acquisition happen through a cash offer? I will buy the company Reliance Limited and merge it into mine. I have to give the target shareholders their consideration in cash. I will say, here is the cash, now get out. Okay, now please do not show me your miserable and ugly face ever again. I'm giving them cash and they will leave. I'm telling them to get out with the cash, do whatever you want. If you want to party, go party. If you want to get a massage in Thailand, go do that. They go take the cash and get a massage in Thailand. I have no problem. My relationship with those shareholders is completely over. They sold the company, I gave them cash, and then they left this company. Understood? Therefore, in this case, you must keep one thing in mind. I am not giving the shareholders of the other company even a single rupee worth of stake in the merged entity. What am I doing? I'm buying their company, giving them cash and sending them off. I will never see their faces again in my life. They will never have single rupees worth of stake in merged entity. Remember that. I will repeat this point later. It's very important. It's the reason why most students make mistakes. Now look, what topic will be formed from this? If a share offer was about issuing how many shares, then a cash offer is about paying how much cash to other shareholders. Cash paid to shareholders of target company. It will be given in the question. For the other shareholder, you'll see. Will you pay 40 lakh rupees cash to buy his company? That's it. Or it can be stated in a different manner that you will pay 40 rupees cash per share. How is this amount calculated? Cash per share x NT. NT's meaning is consistent. Shares outstanding in target pre-merger. The target company had 1 lakh shares outstanding. I will give 40 rupees per share to all shareholders for their existing shares. How much for 1 lakh shareholders? 40 lakh rupees. It was very easy and it's nothing special. Okay, now note one more point here. In a cash offer, the number of equity shares outstanding in the merged entity will equal the number of equity shares outstanding in the acquirer company since no shares are issued to shareholders of the target. The same point I just mentioned. In this case, the NAT, the number of shares outstanding in the merged entity. In this case, it is the NAT. And this will be equal to the NA. How many outstanding shares will be in the merged entity? It will be equal to the number of outstanding shares in the acquirer pre-merger. NAT will always be equal to NA and you will only use NA. Instead of NAT, we will now always use NA in the case of a cash offer. So why is that? Because have I issued any new shares to the target company's shareholders? I am not issuing them any shares for the merger. I'm giving them cash and sending them away. They receive no stake in this entity, remember. So just remember this point. Most students make a mistake in this. In the confusion of the NAT, you will never get NAT into ER. There cannot be an exchange ratio. So what do they do here? They do NA plus NT. That won't happen. Only the acquirer's shares will remain outstanding. No shares have been issued to them. Acquirer's shares form the merged entity. Cash was given. NAT will always be equal to NA. Remember, this point is special. After this, look, the same topics will continue. So how is the post-merger book value calculated? Just keep listening. Post-merger total book value of the merged entity's share capital plus reserve. Share capital is merged entity shares and acquirer's face value per share, as the acquirer forms the merged entity. But now what are the merged entity's shares number? NAT is equal to NA, so NA into face value. Now don't say I made you write NA by mistake. It's not a mistake. It's a cash offer. Add reserves for the acquirer and plus the capital reserve that comes from acquiring the target company. Capital reserve from the acquisition of the target. How will it be calculated in this case? So net asset, in the share offer, we specifically used NT into year into the acquirer's face value per share. What will you do? You are giving cash to other party. You are doing this cash per share into NT, that's the total cash paid amount. This is capital reserve. Let me explain by accounting. When taking over net assets with cash consideration, the difference is capital reserve. Plus or minus, any outcome will be capital reserve, not goodwill. You're making decisions, not proper accounting. Okay, goodwill in minus will become capital reserve. Normally, it will be capital reserve anyway. For a cash offer, the institute doesn't ask this, but if it does by mistake, I have covered every topic for you. Got post-merger book value. BVPS 80 is post-merger book value divided by the merged entity's shares. Simply NA. Just remember that. Now post-merger earnings. Post-merger earnings are calculated as EAT, which is EA plus ET plus any synergy in earnings. Same as in share offer case. One extra adjustment is there. Minus what? Cash per share into NT into interest rate percent, 1 minus tax. How will we remember such a big adjustment? You don't have to remember it, it's logical. What adjustment? It's a very simple adjustment. Look what I'm doing. EA plus ET plus synergy in earnings. So earnings of both entities will merge and shareholders will get these earnings. But when it's a cash offer, then what will happen? An opportunity cost will be incurred for the cash that we paid, and that will be a deductible expense for us. This will be an expense in the entity. Cash per share into NT means the total cash we paid to shareholders. In our example, it was 40 lakh because 40 into 1 lakh shares is 40 lakh. We paid this cash, so we must have taken it out of our safe. Then how will that affect earnings? It won't affect earnings directly, but it will indirectly. Let's say I was investing these earnings somewhere. By investing, I was earning a 10% return. Okay, but now that I have paid the cash, I can't earn a return on it anymore. I was investing it for a 10% return, but now I won't get that. 10% return will be lost, and assuming those earnings previously occurred, we always consider opportunity cost in FM decision making. Those earnings are included in profit. In the future, it won't happen because we paid that much cash, it's gone. So you won't have those future earnings. And if the return was 10%, I won't earn this 4 lakh rupees, which means we must reduce it. But what is this 1 minus tax rate? In future, earning is 4 lakh. But if there are no earnings, then there will be no tax on it either. We must have applied tax on the earnings. In these calculated earnings, the tax adjustment is already done. Tax must be applied on these earnings. If there are no more earnings, then no tax will be applied, which will result in a net tax saving. And so what then will our net loss be? So how much net will it be? Do 1.301 tax rate. Let's say the tax rate is 30%. You should only use the tax rate if it's given in the question, because you can't just assume a rate like 30% on your own. If it's not given, then don't do this tax rate adjustment at all. You should remember this. So 1 minus 0.30, let's say 30%. An earning of 4 lakh from which 30% tax applies and is removed, which means we will have a future loss of 2,80,000. The net loss will be this because before we were earning 4 lakh. After 30% tax, the net 2,80,000 we were earning won't be earned in the future. So that's what I have done. Cash paid, cash per share into NT into interest rate 1 minus tax rate. This adjustment must be minus. After this adjustment, you get the post-merger earning. Now let me tell you one more thing for those who overthink. What will they say? I can tell you today with certainty that 90 or 95% of individuals in the market, even those who became CA, but they don't grasp merger amalgamation procedure. You know what they think? Listen to me. Many mistakenly believe the acquirer's consideration goes to the target company. Money was given to target company. So they think that cash was given to the target. Because we acquired the target company, they mistakenly assume that 40 lakh cash from our example came back to us. So what is opportunity cost is for that money came back after merger. There is no bigger fool than them. I'm telling you, they have never even tried to think about the logic properly. I told you right at the start as the most important principle that to buy something, you pay the owner, not the thing itself. To buy a company, you give consideration to its owners, the shareholders. I will give cash to the target company's shareholders and they'll take the money and leave for their trip to Thailand. They will get massage and party and spend all the money. I know that it's their personal money. They sold the company to me and left, so the company merged into my company. So this 40 lakh isn't coming back to me from any angle. You should remember this, it's not coming back from any angle. This should be clear to you. Now, regarding post-merger earnings and EPS, it's CAT divided by NAT. What is NAT equal to NA? Now, the post-merger market value is calculated in exactly the same way. First, calculate post-merger MPS. If merged entity PE is given, use EPS 80 into P. If merged entity PE is not given, then use VA plus VT plus market synergy. Divide by NAT, which is NA here. Now MPS. But there's one extra adjustment. You will minus cash per share into NT in VA plus VT plus synergy in market value, meaning the cash we paid to other shareholders. So why this? We totaled the pre-merger market values of both companies and added synergy. This will be the market value after the merger. By totaling pre-merger market value, this will become merged entity market value. We are using the pre-merger value, meaning it was the value before. As soon as we merged, we gave them cash. Who did we give it to? The other company's shareholders took it and left. So the value of the acquirer has decreased, right? If I give cash, my value will decrease. Cash will be paid by me. If you have money in your safe and take some out, your value will decrease, right? My value has decreased by this much, by this amount. If someone thinks with same logic, the money surely didn't return to the target. It went to the target shareholders who have taken it and are enjoying it. It didn't go to target. Your value decreases by that much. You subtract this. Then it should have been subtracted in that also. It won't be in the same way. Look at the logic. When you calculate EPS 80, you have already made adjustment for cash per share into NT in earnings. The adjustment has been made per earnings. Calculate MPS by capitalizing earnings with the PE ratio, which means the cash paid adjustment is already made in this. There is no need to do it again. All the logic should be clear. For calculating cost and market value, it's MPS 80 multiplied by NAT and NAT equals NA. The merger's impact, meaning how to calculate merged entity shareholder gain or loss for a cash offer, asked by any name. In this case, there's one common calculation method. On EPS or MPS basis, it simply cannot exist. Why can't it? Did target shareholders get stake in merged entity? Because no stake was given, they get nothing from the merged entity's EPS nor from its MPS. So how do we calculate gain or loss as it is calculated for both? That's why there is no basis. There is one common method. Acquirer shareholders have a stake in the merged entity and pre-merger. Acquirer shareholders can still gain or lose on both EPS and MPS. But it's not done in practical life. Because you can't calculate the target's gain or loss on EPS. That's why we don't calculate the acquirers on EPS either. How will the acquirer's gain or loss be calculated? Calculate it on MPS basis. That is the best way. Acquirer's gain or loss is found via EPS and MPS methods. Though an EPS calculation might be requested, it's not done practically. You must calculate the targets as well. Targets is not possible. The acquirers is based on MPS. MPS at minus pre-merger MPS gain loss per share into NA. So the total gain or loss for the acquirer shareholder remains unchanged. It's very easy. Now we have to calculate target's gain or loss. The target shareholders are not getting a stake in EPS nor in MPS. So how to calculate? There is a different method for them. It's a very easy method and we gave cash to the target shareholders. In return, they gave us company, so cash paid per share. Cash is given minus the pre-merger market price of 1 share. Their per share gain or loss multiplied by target's pre-merger shares totals their gain or loss. How did this come? The logic is simple, so listen carefully. Look, suppose I gave 40 rupees to the target shareholders. Suppose its pre-merger share price is 35. I gave him 40 rupees in exchange for 35 rupees share price, which means he gained 5 rupees per share. Target shareholders accepting the cash offer have nothing to do with company. They just want to go to Thailand and party. If they want to party, they say our pre-merger share price is this. Now give us whatever you want based on this. Understood? So we calculate the gain or loss from their asking price. So cash paid per share targets pre-merger market price. This is also called on the basis of MPS. See, a cash offer was made in this way. Clear? Now for cash offers, a silent situation cannot exist because calculation is straightforward. You can calculate the acquirers on EPS basis, but the question never asks, what's its use practically? You can't calculate targets. Now, remember the true cost of merger. If asked for net cost of acquisition or cost of takeover, no, it's the same. Calculate the total gain or loss to the target shareholders. This is common method. It is the same for acquirer. Net cost of acquisition or true cost of merger, for example. Look, I'll give 40 rupees to target shareholder. One share was worth 35 rupees and I'm giving 5 rupees more. It's a 35 rupee item. I'm taking a 35 rupee company. I'm giving 40 rupees, so I'm giving 5 rupees more. So I gave 40 rupees and in that I got a 35 rupee worth of item, the company. The extra 5 rupees given is my true net cost. The target shareholder's gain or loss is the acquirer's true cost. This topic concludes. Now let's move to next. Maximum cash per share acceptable for acquisition. Maximum cash per share acceptable to the acquirer, the same logic applies. What is the maximum cash or the highest possible price the acquirer will offer to the other company's shareholders? To buy it, what's the maximum money I would give? Since it's not about shares, we are talking about cash. We'll talk about cash per share. What is the maximum cash per share we can offer? The acquirer will offer the maximum amount so that its EPS or its MPS does not get diluted, because acquirer has stake in merged entity. The acquirer calculates on that basis. First, the maximum cash per share without dilution of EPS. This means the acquirer wants to maintain pre-merger EPS in the merged entity. Means the acquirer wants no EPS gain or loss post-merger. It can give that maximum cash. The acquirer wants to make the post-merger EPS 80 equal to its pre-merger EPS of A. Now we need to calculate cash per share. For that, let's expand this once. EAT divided by NA equals EPS of A. This was post-merger EPS. This is calculated, but you can't see cash per share in this. Let's expand it further. NA and EPS of A will be available in the question. So expand EAT. Formula for EAT is EA plus ET plus synergy in earnings if any minus cash per share into NT into interest rate percent into 1 minus tax rate. Divide by NA is equals to EPS of A. It is equal to this. Fill in all the data in this equation and the cash per share will be your balancing figure. Logic is the same. Nothing is different. Exchange ratio was the balancing figure, now cash per share. Now maximum cash per share without MPS dilution. The acquirer wants to maintain its MPS in the merged entity. So post-merger MPS 80 should equal the acquirer's pre-merger MPS. Two formulas for MPS 80. If merged entity PE is given, then it is EPS 80 times that. This must equal MPS of A. We expand for cash per share. EAT divide by NA into PE ratio. Let's expand further. Let's expand EAT, because then we will get cash per share. EA plus ET plus synergy in earnings minus cash per share into NT. Into interest 1 minus tax. Multiplication merged entities PE ratio division NA. This equals MPS of A. So a big equation will be found, but fill in all the data in it. Cash per share balancing figure. What if merged entity PE isn't given? The formula was VA plus VT plus synergy in market value minus cash per share into NT. NA in the denominator, not NAT, because it's NA. Equal to MPS of A. Is the cash per share directly in this equation? You don't need to expand the equation. Cash per share becomes your balancing figure. In silent situation, if you have to find maximum cash per share and nothing is said without dilution of EPS or MPS, how will you calculate it without MPS dilution? It was the same and nothing different, and we did it quickly. If you understood the share offer, you must be understanding these topics. If you didn't grasp this topic, it goes over your head of the concept. Next, minimum cash per share acceptable to the target company. What's the minimum cash acceptable to the other company's shareholders and what will they ask for? Just like what is the minimum number of shares? How much minimum cash per share will Ambani ask for his company? What minimum cash amount will he ask for? He can't discuss EPS or MPS dilution as he wants no merged entity stake. He gets no stake in the merged entity. He takes the cash and leaves for Thailand. Remember this. He wants to party. So he don't use his brain. He won't overthink it. What will he say? He'll simply ask for his pre-merger market price. He will say, give me pre-merger market price. That's minimum. Look at my shares market price. It's 40 rupees. So give me 40 rupees. That's it. Sometimes one more adjustment is needed and I will explain that to you now. He will mainly ask for this. Generally, this is the case. And sometimes a second adjustment occurs. He will ask for his pre-merger MPS of target because he wants to ensure that there is zero gain or loss per share. Target gain loss is calculated by cash per share minus pre-merger MPS. We have to find the cash per share. We'll move the pre-merger MPS across, making it positive. He will ask for pre-merger MPS at least. Clear? So the minimum pre-merger MPS. The other company's shareholder will ask for at least their pre-merger market price. Additionally, he will ask for one more thing. If it's ever there, what will he ask for? Loss of remuneration per share to shareholders of target entity. Loss of remuneration per share to target shareholders, if any. Let's understand this with an example. In my example, let's say the target company is Reliance. Reliance is the target company in my example. In that company, Ambani was a shareholder who we assume has all 1 lakh shares. Now let's assume this in our example for easy understanding. And you know, Ambani was also a top management employee in that company. He was a shareholder and also an employee of the company in top management. Ambani was employed at a good position in that company. and he used to draw a salary of 25 lakh rupees per year. Now what happened? I talked about buying Reliance Limited, about giving money to Ambani. So when I talked about giving money to Ambani, I offered cash consideration. Ambani said my pre-merger market price is 40 rupees, so give me that per share. I told him take the cash and sign over the company. All this is fine, but now there is an extra point. Point is, when I am about to buy Reliance, I have already decided that Ambani, who is employee in the top management, his salary is 25 lakhs per annum, but as soon as I buy and merge it into my company, Ambani will still be employed in my company. He won't be a shareholder because I'm giving him cash, but he will still be an employee and I will keep him in the merged entity. But in future, his salary will be 15 lakhs. I will make his salary 15 lakhs in future because I feel he is drawing 10 lakh more salary. Because he is a shareholder, he draws a higher salary fooling the company. But I know he doesn't deserve such a high salary, so I'll keep him employed after merger and pay him 15 lakh. He said, okay, no problem, because he knows he draws a higher salary and he is ready to be an employee. In this case, Ambani will say, all this is fine. But then if I don't sell you this company, if I don't give you the company now, then I would draw a salary of 25 lakhs. I would earn 25 lakhs. I would have extra 10 lakh benefit, which is gain. But then Ambani is saying that if I sell the company to you, then in the future I will lose 10 lakh rupees. So who will compensate? If you can compensate for this, then I can sell the company. I will ask for at least this much. I don't want to make a loss, and I will ask for minimum amount, ensuring if not gain but no loss occurs. One is the minimum market price of today plus. This 10 lakh rupees loss will incur on how many shares? I have 1 lakh shares. So we need to calculate the loss per share, which is 10 rupees. So in total, I need minimum of 50 rupees. Because if I sell the company, I will have this loss of 10 lakh rupees. This loss occurs upon selling, so you must compensate me for it as well. Because I don't want a loss from the merger. What is the use if I incur a loss? At least if I don't gain, I shouldn't have a loss. So extra remuneration per share. Okay, it was of the other party which he will lose in the future. Make the loss of remuneration per share. Any loss of remuneration, target shareholders will ask as a minimum. I'll explain the cash offer with a question and you will understand more. You will gain command when we write in question bank. With this, your third part of chapter is completed. We will move to the fourth part. Look, this is the fourth part now. Other calculations in mergers and acquisition. We saw that when we buy the other company and merge it into ours, what are the calculations involved in decision making? So if we give a share offer or a cash offer consideration. Now here I am going to tell you two more different other calculations. These calculations are quite useless and not generally used in practical life. These are institute's questions. To do those questions, just notice it and keep it in mind, as otherwise it's not very useful. In merger and acquisition decision making, these calculations are sometimes done. Understand quickly, they're useless. Value of acquisition. What is value of acquisition? Look at the name. The value of acquiring, the value of buying the other company, the value of acquiring the target. The value of acquiring, does it mean the consideration? Meaning the consideration we are giving. As mentioned, many words in this chapter seem similar, but they are not. This came to your mind when discussing the true cost of merger, but it had different meaning. Similarly, the acquisition value is different. I have said the value of acquiring it, and what I have not said is how much value I am giving to acquire it. I meant what is the value for acquiring. I'm not saying that, I'm saying the value of acquisition. There's a subtle difference between them, hence the topic is different. Okay, so in this chapter, we should keep the wordings in mind. The wordings for gross cost of merger or value of acquisition must be clear for you to calculate correctly. What is the meaning of acquisition value? It signifies the acquirer's value addition following target acquisition. And also due to acquiring the target, what will be the addition to the acquirer's value? Meaning it's simple. I will buy the other company and merge it with mine. And as the acquirer, my value and scope will increase. What is the value of acquisition? It's the merged entity's value minus the acquirer's prior value, meaning VAT, VA. VAT is the merged entity's post-merger market value, and VA means pre-merger market capitalization of the acquirer. This value of acquisition arises because buying other company increased my scope, meaning VAT was formed. Post-merger value came for merged entity, market value. And if I didn't buy it, then my value was VA, acquirer's pre-merger market price. This value came from the acquisition. You calculate it in this way. My post-merger value became 180. Before the acquisition, my value was 100. Because of buying the other company, 80 rupees was added to my total value. How much was my value addition? 80 rupees. This point is over. And see, financial feasibility of acquisition is your next topic. It's completely useless. Is there financial feasibility in acquiring the other company? Meaning, if you acquire it, is it financially right for you? Will you benefit or lose by acquiring them? We did these many calculations just to check this out. Useless calculation, but the institute does. The institute mixes accounting, a practice it did 25 to 30 years ago. The institute's habit has been copy pasting the same question. Therefore, in the module, I'm making you do this for one question. It's of no use. It mixes accounting points in it. Just take a look once. Don't think too much. Look, now you have to check the financial feasibility of the acquisition. So what do you have to do? You have to calculate NPV in a way. You will acquire the target company, then merge it into yours. Now we will assume I will run it as a separate business. So if I run it, I will get cash flows from it after acquisition. So if you do its PV, it will tell you the benefit I get from buying the other company. By buying the other company, I will run it separately. A separate business within my company with future cash flows. If you do their PV after acquisition, the benefit is the PV of cash inflows from the target company after acquisition. This will be my benefit. Minus the expense to acquire the target company. What is the benefit of acquiring the target company? Minus the outflow required to acquire it. This NPV indicates acquisition profitability or loss. Minus the initial net outflow to acquire the target. How much net outflow did I have at time 0 at the beginning to acquire the target company? At time 0, PV is same. No separate calculation needed. This gives NPV. Suppose the PV of cash inflow from acquiring it is 100. The net outflow to acquire it at time 0 was 80 rupees. So there's a net benefit of 20 rupees, which shows it's financially feasible. Alright, so if the NPV is positive, acquisition is advantageous, and if NPV is negative, the acquisition is not advantageous. It's simple. Keep this crucial point in mind. From the question where how to calculate initial net outflow. Remember how to calculate the initial net outflow for target acquisition. All you give to the target company. All those things. First of all, the target company. I will issue equity shares as consideration to acquire its shareholders. When issuing equity shares, you must determine their value, which represents the outflow. Shares issued multiplied by my shares MPS. You need it in terms of amount, right? Shares issued multiplied by acquirer's MPS, or cash amount if given, in consideration. Besides this, what happens is that the institute mixes accounting in this. When acquiring a target company, we make it completely ours. This means addressing any people with liabilities. We want to remove them from the company, not wishing to see their faces, for complete control. Some debenture holders were listed as a liability in the target company. I decided that when I acquire this company, I will issue my company's shares or debentures to these debenture holders. Include that too, it's an issuance of debentures from my side. But doesn't issuing debentures bring in money? I am issuing debentures freely because they were a liability in the target company. So that liability is now mine. Those debentures are now in my books, so I will have to pay for them, which is my outflow. Alright, for free, otherwise that logic should have applied from the start. When you issue equity shares, consideration comes in. It's given freely, the company is acquired. There were debenture holders in the target company, and for settlement, I issued my own debentures. Furthermore, the target company had current liabilities known as external liabilities. I want to settle them as well, so I gave them a settlement amount. I told them to leave too. This was an outflow from my side, making these the 3 outflows. Apart from this, one thing will be subtracted. When we acquire a target company, I might see an amount for the debtors or some inventory in that company. As soon as I acquire it, I collected money from the debtors and also promptly realized the amounts by selling the inventory. And there was some cash in the target company's books and the cash in its books. So when I acquired and merged the target company, the cash in its books became mine, and I'm talking about its own cash. That has become mine. This occurs in the valuation. That becomes yours. You also receive this amount at time 0 less the amount realized from target assets. You immediately get cash from debtors, receivables and inventory. That's why I've kept the net outflow here. Subtract this outflow from it. Remember this, the silly topic is now complete. Now let's move to the last part of the chapter, part 5, other types of corporate restructuring. We started the chapter with corporate restructuring. You understood the merger and acquisition part well, which is the main focus of this chapter. But there are other types of corporate restructuring which I had told you about. Demerger or internal reconstruction, which you were calling financial restructuring. Stock split up. bonus issue and equity buyback. So now let's understand all these parts. They are small. You won't face much difficulty. Just listen carefully. First of all, demerger. Understand what demerger means. Do you know what demerger means? A company separates a particular part of itself, a division, and then sells it to another company. You separate part of your company and sell it to another. A merger was when I acquired a target company and merged it into mine. Merger involved buying and integrating a company. Demerger adds D to merger. Derived from merger, I have to separate part of my company. In a demerger, always remember, selling the entire company is not called a demerger. If I sell my entire company, would that be called a demerger? No. If I separate a division or even just a part of my company and then sell it to another entity, that is called a demerger. The separate company I formed and sold will be the resulting company because it's effectively the acquirer having bought that division from me. Now I will become the demerged company, which for it is like the target. Pay close attention to this. Let me give you an example. A Limited, a company with two business, laptops and mobiles. Now its management sees a good margin in the laptop business, so they focus on that. They don't focus on the mobile division, so there's no growth. The company needs to increase its growth, so it decided to create a separate company for the mobile division, Mobile Limited, and transfer the mobile division to it. This resulting company, the acquirer, buys the mobile division from a limited. A Limited became the demerged company. If you think of it like a merger, then this has become the target company in a way. Remember, the entire company isn't sold. In this case, remember, the resulting company will issue equity shares to the existing shareholders of the demerged company. Remember, this is how it usually happens. Why would it do that? Look. A Limited operates in two divisions, laptop and mobile. The mobile division was given to a new company, Mobile Limited. For this, we create a new company ourselves so that it will have new management that will work with full focus, leading to growth. When Mobile Limited was formed and received the division, it will give consideration by issuing equity shares. It could be given in cash. Cash isn't possible. I'll tell you why. Mobile Limited, to whom will it issue consideration? A Limited shareholders. Remember, the consideration goes to the shareholders of A Limited because they are the owners, the shareholders. It issues shares to A Limited shareholders. Understood? This type of demerger is called a spin-off. Understood. Since it's given to shareholders, you will ultimately see A Limited shareholders also have control over A Limited. And A Limited shareholders also control Mobile Limited. Meaning, ultimately, it's quite clear that the same company that used to control the mobile division will still continue to fully control it. Just as a separate company, nothing else is happening. Remember this. A demerger can also happen this way. For instance, another company in the market could buy a division from us. Suppose A Limited operated laptop and mobile divisions, an existing market company, Apple company. It bought my mobile division because I couldn't handle it, so I sold it to that company. Apple Inc. will give money to whom? To A Limited's shareholders. Then it will directly pay cash. Apple Inc. won't give its stake, its equity shares. It will say, take the cash, we just bought a division from you. So it might sometimes give equity shares, but it will give so few shares that its control is not diluted, say 5-10%. Understood? So this case is not in your syllabus for the practical part here. This is in the accounting part, but here in this subject, it's not in the syllabus for the practical part. Your case is this one, which you call a spin-off. The other company will issue shares only to the shareholders of the demerged company so that they get control. This type of demerger is called a spin-off. We call it spin-off. If it had paid in the cash, then these shareholders would have no control over Mobile Limited. If they didn't have control, then Mobile Limited would be a separate company controlled by someone else. We are not doing that. Instead, we are creating this company ourselves. In demerger, remember, we create a separate company, give it a division, and it issues shares to our shareholders. After this, remember the demerger's effect, which is useful for questions. The demerged company, the division it sold, the mobile division and its assets and liabilities. We will transfer their assets and liabilities to Mobile Limited, right? After giving them, after the demerger, what assets and liabilities remain with the demerged company? Only those of the unsold division, the laptop division. Remember that. Post demerger, the demerged company will only have the laptop division's assets and liabilities. Mobile Limited will have the mobile division assets. The demerged company's outstanding equity shares will remain unchanged after the demerger. After the demerger, the demerged company's outstanding equity shares remain the same. They remain the same as before the demerger. Note, many students make mistakes. Understand with example. Look, there is a demerged company A Limited, and its number of outstanding shares is 1000, which were issued in the market before the demerger. It took its mobile division and gave it to Mobile Limited, the new company. Alright, this is what happened. So far, there should be no change in the number of 1000 shares. After the demerger, this Mobile Limited will issue shares in the market. And to whom? To the shareholders of A Limited. Suppose it issued 200 shares. So whose outstanding shares are these? They belong to Mobile Limited because Mobile Limited issued the shares. Do you know what some people do? Somehow they think, but they increase the shares of this company. They mistakenly increase the demerged company's shares to 1200, confusing it with mergers. And why would its shares increase? It hasn't issued any shares. Mobile Limited is issuing the shares, so they will only come in its outstanding shares. Its shares can never increase and will remain the same because a demerger has no impact. Its shares increase because shareholders receive 200 shares. If its shareholders receive them, their investments are in two places. The shareholders of A Limited have an investment in 1000 shares of A Limited and also have 200 shares of Mobile Limited. The shareholders of A Limited have an investment in 1200 shares, not that the company has 1200 shares. But even if you think that, say, the demerged company is being issued shares, this also cannot happen. That doesn't happen. Even then, its share capital wouldn't increase. If it is issued shares, it will be an investment for it, not its share capital. Share capital investment, you should at least know the difference between these. All right. So I have clarified this point. With this topic is complete. Let me link the questions once more. Let's move to next topic. Reconstruction or financial restructuring. Reconstruction or financial restructuring. You must have studied internal reconstruction accounting in intermediate. The company is ruined, it's nearing collapse, and it can shut down anytime. Why? Because it's incurring huge losses. Huge losses on company's balance sheet. The debit balance of the P&L can appear on the asset side or as negative reserves, which is the common practice nowadays. Sometimes the institute's balance sheets show P&L debit on the asset side, meaning a P&L loss. As the institute follows old practices, this is possible, so you don't have to panic. This means company faces immediate shutdown. So if the company is to be revived now, it will have to undergo internal reconstruction, financial restructuring, the entire process of which you have learned, you have done the accounting. Now point is that you don't have to do accounting, but method will be same. You'll apply the same internal reconstruction calculations here, because you have to see that we are making a plan for internal reconstruction, that we will do it in this way. So what will be its effect? We'll check its effect. The transaction hasn't happened, but the calculation method is same, just accounting isn't done. To calculate this, to calculate the impact of financial restructuring. To calculate the impact of financial restructuring, you need to work in 3 steps. How will you do it? First, understand how financial restructuring is done. Financial restructuring will happen. Let's say A Limited is company that is doing poorly. It can shut down anytime, and if it does, what happens? Shutting down means the company will have losses, then an application will be filed in court to declare myself completely insolvent and completely bankrupt. The company was declared bankrupt and insolvent. Then all the stakeholders of the company will lose their money, be it the shareholders or debenture holders or creditors, etc. Even a preference shareholder won't get a single rupee, as the company will declare itself insolvent and bankrupt. Where will funds now come from? The company has no liability and simply goes. So the company is on the verge of collapse because there are losses in the balance sheet. To revive, the company needs money. Because now if the company gets new money, it will invest it in the business, and after that the business might revive. So for new money, the company will either have to take a loan or issue new equity shares. Look at the company's balance sheet. Looking at it, no one wants to give money because the balance sheet shows huge losses, negative reserves. Alright, the balance sheet reflects the company's position, image, and what the company is like. Balance sheet bad, company bad. The company must improve its image by enhancing the balance sheet, making its losses disappear. Convert negative reserves into positive reserves. So how to do it? You can do some fraud or just make adjustments. No, not by fraud. Doing it fraudulently will actually harm the existing stakeholders as well as all the future stakeholders. So what is the right way to do it? What will the company do the right way? The company will go to its existing stakeholders, that is equity shareholders, preference holders, debenture holders, creditors, all these people. These people will be the most concerned about the company because their money is stuck in the company. What company will tell these people? It will say, whatever money you claim from me, please take small cut and make little sacrifice. Consequently, these people will start cursing. Why should we do that? For example, equity capital is 100 rupees. So in a way, that's 100 rupees. Debenture holders have a liability of 500, meaning they claim that amount, and creditors have a due amount of 1000 rupees. I told equity holders, you claim 100, make it 60, forgive 40 rupees. I told the debenture holders, you claim 500, right? Forgive 250, let 250 remain, forgive half. I told the creditors, you claim 1000 rupees from me, right? Let it be only 200, forgive 800. All of them started cursing. They protested, asking why forgive their rightful money. The company said, listen to me. If you forgive it, you will be better off. They asked how. It said that if you don't forgive it, the company will be ruined because no one else will lend money. If it's ruined, it will be declared bankrupt and you will get nothing. And what am I saying now? Forgive this much money. What I tell equity holders, claim 60 instead of 100, forgive 40, reducing capital by 40. I'm telling debenture holders, make the liability 250 instead of 500. Creditors' liability is now 200 instead of 1000 by forgiving some of the money. As a result of this, the company's entire image will now improve, and that is because you have forgiven the money. And then I will definitely try to revive the business with fresh new funds. If the business revives successfully, then the money you all have left, you're guaranteed to get that much, otherwise nothing. Then these people will discuss. They'll say point is valid. It's better to lose some money than to lose all of it. So these people will sacrifice a little among themselves. Everyone has to sacrifice, everyone will have to. So everyone will sacrifice a little. Now, let's fully understand this from the horizontal balance sheet. If a question on preparing a balance sheet comes, which is rare for this subject, the institute has no fixed vertical or horizontal format and will mostly prepare a horizontal one. Make what you do prefer. This is not accounting, so the format earns no marks. It's about calculation. So let us now understand this: equity, preference, and debenture. Sacrificing their money means we are talking about reducing their balance. So how will our balance sheet match then? As they were on the liability side, if the money in liabilities decreases, all these liabilities will be debited: equity share capital, preference share capital, debentures, and creditors. You must have learned to pass accounting entries. Debit all these, liability decreases. So there will be less money on the liability side, meaning you are now reducing the liability amount to increase the company's reserves. You are increasing company reserves, so negative reserves can be covered. This is the company's benefit. If liability holders demand less, increase company reserves by that amount and credit them. Make it to capital reserve. First, calculate the company's benefit from reconstruction. It comes from liability holders reducing their claims. Equity share capital reduction. 100 rupee shares at 60, 40 left. Now this is in the total amount. This reduction, you must do this the normal way, as many confuse this reduction with splitting share value, a topic I'll cover later. Instead, we are directly reducing the money in their value. We are reducing their money, not splitting shares, but their value. Similarly, they've reduced preference share capital. Plus, we were able to get the debt holders to waive or forgo their claims, effectively meaning we got them to fully forgive their claims. This includes debentures or their accrued but unpaid interest. If any such liability had accrued, it would be listed in the liabilities. Debenture holders refused to forgive the principal amount, but the interest accrued. Let's say they forgive that. We will take that here. Forgiveness from trade creditors is taken. Plus appreciation in the value of an asset. When we reduce something on the liability side, we benefit. See if you can increase some value on the asset side. How can we increase value on the asset side? Revalue fixed assets if it hasn't been done. Revalue fixed assets. If market value exceeds book value, upward revaluation occurs. Say book value is 100 rupees. The market value is 150. So the assets value increases by 50 rupees. This benefit from the upward revaluation should also be considered. This is reconstruction benefit. In this second step, now we will utilize this benefit. Where will we utilize it? If any fictitious asset appears in our balance sheet, write it off first. Preliminary expenses and debenture issue costs. These don't exist nowadays because they go directly to P&L. But in the institute's older questions, you might find them on the asset side. Any such fictitious asset on the asset side, write it off first. To write off, credit their debit. You must have debited them. This benefit got debited. And if you have debited that benefit, you will use it by crediting this because they initially have a debit, and to eliminate them, you must credit them. Similarly, if there's a P&L debit balance or negative reserves which have a debit balance, then to eliminate them, you credit, meaning write it off. Apart from this, see what happens. When a company is going bankrupt, it suffers even more losses. You must have heard the saying, poverty adds to the misery. Similarly, a company goes bankrupt. Its debtors from whom company was supposed to collect money think company is ruined, so I might as well cheat it out of its money. So I feel that I have a debtor of 100 rupees. He is not going to pay 20 rupees. So the provision for that, you can create it from this benefit as well. Provision for bad debts. When you are doing revaluation, do it for every asset we did upward revaluation. Suppose after revaluing an asset, downward revaluation being written down. It turns out an asset with a book value of 100 rupees. Market value of 70 means write down 30 rupee, which is also an expense. If you have to reduce an asset, you credit it and add that here. You have now utilized the total benefit amount. In step 3, calculate capital reserve. Benefit from step 1 minus utilized amount. This amount of the reserve is what is left. We had a benefit of 100 rupees from their reduction, but we utilized 800 rupees here, so a capital reserve of 200 rupees is still left. 100 rupees reserve was shown. If it was 100 and was utilized, then it's finished, no reserve is left. Can it be negative? A benefit of 100 and utilized 1100. Not possible. Earned less benefit, utilized more. How is it possible? In accounting, you debited the benefits and credited all these. Where's the negative capital reserve debited? Meaning a benefit of 100 was gained and 1100 was to be utilized. This means our reserve is still negative by 100. In that case, it will come out like this. So follow these steps. With this topic is also complete. It's a completely waste topic. Now come to next one. Stock split up. Your next method, other corporate restructuring types. This is a process in which a company, its number of outstanding equity shares. What does it do? It increases its outstanding equity shares. The face value per share decreases. The total amount of share capital remains the same after the split up. And here's what the company is doing. You'll find it in some questions. In a stock split up, the company wants to increase its number of equity shares. It decreases the face value per share. And it wants to maintain the same share capital. There are three things involved: the number of shares to increase, face value per share decreases, and the share capital remains the same. These are the three aspects. What is happening? Suppose the company's share has a particularly high market value, and for instance, one share is worth rupees 1 lakh. When a company's share value becomes very high, the company often splits its shares into pieces because they have become very valuable. Company wants to divide share into 5 pieces, breaking this share into 5 parts. So one share will become worth approximately 20,000 each. This is what is called stock split up. When a company wants to split shares into pieces, to split shares, face value must decrease. How will market price be affected? Look, if you decrease the face value per share, it will automatically impact the market price determined by demand and supply. And when face value falls, demand and supply adjust accordingly, as it's an automatic impact. A 1 lakh rupee share split into 5 retains its market value. Capital value remains the same. We just need to increase the number of shares and decrease the face value per share. I gave you an example. Suppose there is a cake, 500 gram, and you cut it into 5 pieces of 100 gram. You made more pieces, but if you put them together, the ultimate weight is still 500 grams. That's all there is to it. So look, suppose existing, one share has a face value of rupees 100. The company wants to make the new face value of the share rupees 20 because it needs to reduce this value. So it wants to make the new face value of the share 20 rupees. Suppose the existing share capital is 1 lakh rupees. Then what's the existing number of shares? At 100 rupees face value, 1000 existing shares. What will the new share capital be? You'll say 1000 shares at 20 face value, so 20,000, and then the balance sheet won't match. We don't want to reduce the share capital. We want to increase number of shares and decrease face value per share, split stock, divide it into pieces. We need to keep share capital same, so balance sheet remains maintained. Balance sheet remains same. So what needs to be done? You need to maintain the same share capital, which is calculated as the number of shares into face value. You need to find out how many shares the company should have after the split up. The share capital must remain the existing 1 lakh. This multiplication by face value means you will divide by the new face value of 20. We need to maintain this. So our future capital should be 1 lakh as same as it is today. It should be the same thing in the future. And with a future face value per share of 20, how many shares will there be? 5,000. This means we need to convert each existing share into 5 shares. I have to split it into 5 shares, meaning the number of shares outstanding after the split up will be 5,000. Just remember that. To get the number of equity shares outstanding after the split up, divide the existing share capital by the new face value per share. Remember this, I've explained it logically, it's not useful. Now look next. In other corporate restructuring types, we have bonus issue. What does bonus issue mean? It is a process in which a company issues shares to its existing shareholders without consideration by capitalization of reserves. Issuing free shares to existing shareholders. By capitalizing my reserves and not taking any money, because my treasury, that is reserves, has a lot of money, I decided to capitalize reserves into shares for existing shareholders. They will be happy as money is just sitting idle. It's given for free. After all, the shareholders have a right to the reserves. Shareholders' right to reserves is a basic AFM concept. That equity shareholders have a full right to the reserves, we take it along in every calculation. The owner has the right to the treasury. Owners receive their own money converted into shares. Why ask for new funds? When bonus shares are issued to existing shareholders by capitalizing reserves, no money is taken from them because these are free shares. I'll give you an example. Suppose it's your mother's birthday at your home. You took 20,000 rupees from your father for your mother's gift. So you took 20,000 from your father for a mobile phone. You bought it and gifted it to your mother. So 20,000 you had belonged to your parents. You took it from them, converted it into a mobile phone and gifted it back to them. The money was theirs, you just returned it, and they were happy with your thoughtfulness. Equity shareholders will be happy the company considered them, their money simply converted. Taken from the reserves and converted into shares and nothing else. So how is the bonus given to you? Example, the question gives a bonus ratio of 1:4. What does this mean? For every 4 shares, you are going to issue 1 bonus share for free. For every 4 existing shares, 1 bonus share is going to be given. So what impact does a bonus have? What is the effect? Questions on this come in your exam. Now understand this carefully. Due to a bonus, the number of outstanding shares then increases. The impact I'm about to tell you, even if not stated, it should be clear. These are basic points. Will the company's outstanding shares increase due to a bonus? Yes, they will. What will be the number of equity shares outstanding after the bonus? It will be the number of equity shares outstanding before the bonus were bonus shares. Understand with an example. There is a company and it has issued 1,000 shares in the market. All right. The bonus ratio is 1 for every 4. So 1,000 shares by 4 gives you as 250 bonus shares. So the total shares after the bonus will be 1250 because it's 1,000 plus 250. This is so simple. It's in the notes and useful in questions, yet students, consider questions on this topic tough. Such an easy topic. Look, the amount of share capital after the bonus issue increases. How will the share capital be after bonus? Take the increased number of outstanding equity shares. Multiply by face value per share. Previously, 1,000 shares at 100 face value made 1 lakh capital. Company has 1,250 shares. At 100 face value, capital is 1,25,000. The amount of share capital increases after the bonus. Remember this. It increases by bonus shares multiplied by face value. 250 into 100 is 25,000. After this, the amount of reserves will decrease after the bonus issue. After the bonus issue, the company's reserve amount decreases because the bonus issue was given from the reserves. Money was taken from the reserves and converted into bonus shares. I just told you this. To get the reserves after the bonus, you need to find the company's reserve money. What was reserve amount before bonus minus bonus shares into face value per share? Do we have to remember this? No need to remember, it's logical. You must have learned the accounting for bonus. Just recall it. Why recall? Just listen the accounting once so that you remember this topic forever. When you issue shares, what do? To share capital. You take money from the bank. But in a bonus issue, money is not coming from the bank. What should I debit? To share capital. You are writing off the reserve, and since it has a credit balance, you debit it. Reserve account debit to share capital for the value of the bonus shares. 250 shares at 100 face value equals 25,000 for the company. That's all it is. So the reserve decreased by this amount. Reserve was reduced by bonus shares times face value, like 250 shares at 100. The initial capital was 1 lakh and is now 1.25 lakh, meaning the capital increases by 25,000 and this amount comes from the reserve. So the balance sheet will automatically match. Is it clear? You must know this. This comes in a question and students can never understand it even though they have studied the accounting for bonus. I have just repeated same thing. Now, what happens to the EPS after the bonus issue? After bonus issue, what about EPS or earnings? They will change. It's easy. Take the earnings available to equity shareholders before the bonus, company earnings. Now, company's earnings available to equity shareholders before bonus will continue. Why? What change will occur in the earnings? In a merger, we add the target company's earnings. Our earnings remain unchanged in a bonus issue. We assume these same earnings will continue in the future. Take the equity shareholders' earnings before bonus as it is. but now the number of shares will have increased after the bonus. So take the number of equity shares outstanding after the bonus. This will be the EPS after the bonus issue. Do you know what this EPS means? It's the EPS immediately after the bonus issue. Not after a year or after some time. Then the earnings and all would be given differently. This is immediately after the bonus issue. Now tell me what the EPS is. Instantly means immediately after that. Similarly, what will be the MPS after the bonus issue? The formula for MPS is EPS into PE ratio. Calculate post bonus EPS. Multiply by PE ratio. Ratio constant, company same. It's very easy. Finally, what is the market capitalization after the bonus issue? You multiply the post bonus MPS by the new number of shares. Topic is complete. Now let's see the next. Equity buyback or share repurchase, which you can also call ownership restructuring. I am a company. I have issued around 1000 shares in the market, but I want to buy back 200 shares. I am restructuring my ownership. Those shares are with someone else and their percentage control needs managing. I'll explain that with an example. Suppose 60,000 shares of my company are with the promoters and 40,000, okay, sorry, we were dealing with 1000 shares only. So suppose 600 shares are with the promoters. 400 shares are mine. With non-promoters, the 400 shares with the non-promoters, I want to buy back 200 of them. Buyback means the company is directly buying shares and destroying them. The company's outstanding shares are now 800. This means the promoter's stake. I haven't changed the promoter's share count, but their stake increases in percentage terms. So if you want to increase the promoter's stake in this way, which is to restructure the ownership, if you want to increase or decrease someone's ownership structure, you can apply the equity by buyback method to repurchase shares. What is the meaning of equity buyback? It is a process where a company buys its own equity shares from the market to reduce outstanding equity shares. I have too many outstanding equity shares in the market, so to reduce them, the company can buy back the equity. To do a buyback, I will have to give money. I can't buy shares for free. So the buyback price, the price at which shares are bought back. The price at which I will buy back the shares is generally at a premium over the current market price of the shares. Generally, it's premium to market price. Let's see an example. Suppose there are 1000 outstanding shares before the buyback. I want to buy back 200 shares, and for these 200 shares, I will make an offer. Look, I'm telling you that the market price of one share today is 100 rupees. So take 100 rupees and give me the share. I would like to buy it back. Shareholders could also refuse. We can get 100 rupees in market. If we wanted to sell, we would have sold in market. Why should we give our shares for buyback? What does the company do in such a case? Generally, it offers a premium over current market price. The market price is 100 and will give you 10% extra. That's 110 rupees per share. So now sell your shares. Shareholders think market price is 100. Who knows if the share price will rise or fall in the future? Who wants the headache? The company is buying for 110. Sell and exit directly. The buyback price usually carries a premium over market price. It is said generally, it's not a fixed rule. Actually, the buyback price can be lower than the market price. It could be equal to it, or in questions, it could be equal, lower, anything possible. But you generally find it like this. Remember that. How is the buyback price per share calculated? Current market price plus the buyback, the premium per share, the extra premium paid. After this, what is the total amount you will need to carry out a buyback? Look, we need to do a buyback. I have announced that I will buy back 200 shares at this price. First, determine total required amount. The announcement is already made. Will I have to pay the total amount to buy back the shares to purchase them? 200 into 110 is 22,000 rupees. I announced the buyback and later found no treasury funds. Shareholders will then demand payment for shares bought back but unpaid. So I have to plan in advance about the total amount required for the buyback. The amount is very simple. It's calculated by taking shares bought back into the buyback price per share. That's it. Very easy. After this, let's now see the equity buyback effects. The number of outstanding equity shares decreases after a buyback, while in a bonus issue it increases. How equity shares outstanding before buyback minus shares bought back? 1000 shares minus 200 equals 800. Simple. Now for the EPS after buyback, think with the same logic. What will be the company's post-buyback EPS? What were the earnings available to equity shareholders before buyback? Assume this continues in future. Divided by equity shares outstanding after buyback. This will change. Only one adjustment in the numerator. What is it? We subtract the buyback loan interest times 1 minus tax rate. Why are we doing this? Interest on loan taken for buyback times 1 minus tax rate. What is this we have done? Now listen to this carefully. Look, Take the earnings available to equity holders before buyback as it is, because this will continue in future. Dividing by the shares after buyback gives the answer, but a subtraction is necessary. What will you subtract? The total amount needed for the buyback, as I just mentioned, is 22,000. But I saw that I don't have this amount in my treasury. I have to take a loan to get the money, and only then will I be able to pay. And if I take a loan, there will be interest, let's say 10%. This means 10% of 22,000, which is an interest cost of 2200. If I buy back, then I have to pay for it. If I take a loan, there will be interest cost. So expense of 2200 has increased. Prior earnings omit expense of 22,100. But if there is an expense, there will also be tax savings. This expense will bring tax savings because earnings are already after tax. So what then is the net expense after tax saving? It's the interest expense 1 minus tax rate. Alright, let's say the tax rate is 30%, so with that. So this will be my net expense. Subtract this in the future. You'll get these earnings, it's very easy, and this is an additional step in a buyback. Clear? How is interest on the buyback loan calculated? Total buyback amount into loan interest rate percentage. This is logical, no memorization needed. Market price after buyback, it is EPS after buyback into PE ratio. Market capitalization after buyback is market price after buyback x shares after buyback. With this, your entire topic is now complete, and I have revised all the chapter concepts thoroughly from A to Z. I have even told you about concepts that are discussed in the regular batch classes for conceptual clarity, which are not even required for solving questions. There are more detailed discussions, but we can't stretch this video that long, so we won't get into all that. I have covered all the concepts. Now that you have revised these concepts, read the concept notes once and then revise from the question bank, for which I have provided A to Z solutions in writing during class. You will easily revise all the questions without difficulty. And for those who have not taken the class, those who are only watching on YouTube, read notes, revise, solve the questions from question bank yourself and match the answers. Don't directly look at the question bank solution because you won't understand the concepts. Solve some yourself, then match. If anyone has a doubt, whether a class student or not, you can send a message. Message me because I reply to every student, and it would be even better if you post it in the video's comments. In video comments, let me know how you liked the video. Alright, so you can tell me a little about that too. It gives me motivation and feels good. If you liked it and if there's anything to improve, I will do that too. Alright, and remember, you can message me with doubts anytime, whether you are a class student or not. You must follow this. Now let's see something from the question bank. I will explain some special points from questions for those who are not my class students, so that they can understand those points. Look, I have created the question bank category wise, Within categories, the topics are arranged in the sequence we studied. So in class, we do questions 1, 2, 3 onwards, and we never first solve question number 40. We never did something like jump to 28. We went 1, 2, 3 onwards as topics were studied easy to hard and questions align. These are very basic questions, and in these you are asked for the swap ratio and are given 3 bases along with their respective weights, and then we calculated the final result based on that. In the last, we did this solution. The data for these weights were given to you. We calculated all 3, applied the weights, and found the exchange ratio. The questions were done this way. This is basic and has no special points. Look, these types of questions you see. Here you need to find the book value per share after the acquisition and merger. So the same point will apply here in this, all the students who have not studied from me. Every student has a doubt here. How did this come? How did the balance of reserve come? How did the 450 come? This is it. Now don't look at it directly. Follow what was taught in the notes. I have taught how to calculate the reserves balance after. See the valuation post merger. I have shown you the solution. Look. In share capital, the merged entity's shares into face value per share of the acquirer, plus in it the acquirers, plus the target's capital reserve on acquisition, calculated as the target's book value minus the face value of shares given. 450. Book value is here. In class, I showed you how we calculated this BVS. So we have done all the answers, so you should follow accordingly. There is a doubt in this which I mentioned. Along with this, there is a point in this in which you have bonus shares. And you are doing share split, so due to the bonus shares, the reserves will change again and the share capital will also change. See this question part as well. A quick revision. Look, with the bonus issue, the capital was 350. A 1/2 bonus issue occurs and the capital increases to this total. Means the reserves will decrease by same amount, so these will be the reserves. What was written in notes will be applied. Stock split also occurs, making this the total capital. A 5 rupee share will then create this many shares. After this, you don't have to do anything. It's directly asking for BVPS after merger. Total book value divided by shares. And EPS has been asked, so we did that accordingly. After this, look, this is a bank related question. In the bank related question, some information is provided to you. What must you calculate? Swap ratio. So how do we apply this now? If you just look here, gross NPA, capital adequacy ratio, MPS and BVPS. So capital adequacy ratio, MPS, BVPS, all these are positive parameters. Target divided by acquirers parameter. NPA is a negative parameter, so first comes acquirers, then target's denominator. Many students have doubts about this, but you should never have any doubts. I'll clear them. Preliminary expenses are given. Remember to adjust them when calculating book value. It is the institute's mistake, which is not very common these days. Besides this, there is another doubt in this question. I don't know why it even arises. The formula for CAR is given in the question. And this is the specific formula for the NPA. After this, the question asks you to calculate the CAR and NPA ratios for the merged entity, and do you know the formula? But how will we calculate these risk-weighted assets? In this formula, the CAR percentage is given. The individual company's book value is given. Can't you calculate the risk-weighted assets of the individual company by using data in the formula? Their total will be the merged entities. Similarly, the individual entities advance and NPA ratio are given. So can't you calculate the individual NPA amount and then the merged entities? Merged entity ratio will come. No doubt should arise in these, but they do arise. After this, look, this is the question. In this, we have the exchange ratio. We are discharging by giving shares. However, the question states the total amount of consideration. So in this, the same topic will be there. Amount of consideration is given and you are giving it through a share offer. You must divide consideration by the MPS of A. Here in T Limited's offer, you are giving this much consideration. But you have to tell the shares to be issued, so we divided by our share price and we got it. This is one of the 1 or 2 questions where amount of consideration is given. One more point in this question. E Limited has also made an offer to give me 1 share for every 2 shares on the basis of market price. Look, if you calculate on the basis of market price, it will be the same. If you calculate on basis of market price, 110 divided by 220 means 1 by 2. 1 share for every 2. The question asks for the net consideration payable. So how much net consideration will we give to other party? How to calculate the consideration in this case? It's very easy. The other party has 6 lakh shares. How many shares do we have to give? For every 2, 1 share. The exchange ratio is 1 by 2. So check what your answer is. How many shares will we be issuing? 6 lakh into 1 by 2, 3 lakh shares. We issue 3 lakh shares, state the consideration amount. What is the worth of 3 lakh shares I will be issuing? Look at the acquirer's market price. The price of 1 share is 220. Issue shares at market price specified. This consideration relates to shares issued in the second case, calculated as 3 lakh, 6 lakh into 1 by 2. So when you look at this solution directly, you never understand it. Otherwise, it's easy. Now look ahead. This question, inventory and debtor turnover ratios are included. In this question, you need the sales amount to proceed with the working. I won't go into all those details right now. I have covered it in class. So for the sales amount, do you think that this inventory turnover ratio means COGS divided by inventory? The debtor turnover ratio is sales divided by debtors, and let's use it. We will get the answer. If we calculate COGS using the inventory turnover ratio, we will have to convert the GP ratio to a COGS ratio, which will be lengthy. So the students who are doing this, they still don't know the basics of AFM, which I have taught in the basics. The formula for the debtor turnover ratio is not sales by debtor. Its formula is credit sales by debtor, and we need total sales, but cash sales are not provided in this question. So this formula is given just to confuse you so that you get the question wrong. The debtor turnover ratio has no role in this question. We must use inventory turnover ratio. Some students say the institute uses inventory turnover ratio, but their debtor turnover calculation often doesn't match. And your answer will never match because your concepts are not clear. Clear these concepts and you will never have problems, and stop blaming the institute. The institute is not wrong everywhere. We point it out when it's wrong because the institute is not that great and their condition is very bad. But if their condition is bad, we don't have to make our condition worse. We at least have to match their level, right? Okay, so you should keep that in mind. After this, look. This question asks for post-merger market value and the PE ratio remains unchanged. If you want the post-merger firm value, you need the post-merger MPS. For that, PE ratio will remain same, meaning acquirer's PE ratio will continue. The acquirer's PE ratio is given here. Such a line indicates that the merged entity's PE ratio is provided. Don't say it's missing. It asks what will be the profit for the shareholders due to the merger. Nothing is mentioned on basis of EPS, MPS, then calculate on basis of MPS. We have done all this. It says expected market price of A Limited after acquisition or the merged entity's market price. PE multiple remains unchanged. Acquirer's PE ratio remains unchanged for the merged entity. It gives you wording like this. You should focus on this. What will be the MPS after acquisition in this question? Assuming the PE ratio is adversely affected by 10%. This means the acquirer's PE ratio will decrease by 10% in the merged entity. So the merged entity's PE ratio will become 9. Now I will check the questions if there are any other points. Now look, if you look at this question, nowhere does it say what the PE ratio of the merged entity should be, right? In this question, it says, calculate post-merger market value. Use the formula. For maximum exchange ratio, no issue without EPS dilution, but the MPS one. Acquirer calculates maximum exchange ratio MPS 80. PE ratio is not mentioned, so use VA plus VT plus synergy in market value. VA the acquirer's pre-merger market value and VT the target's pre-merger market value. Synergy amount is not given. The question says to ignore synergy, assuming its amount is 0. Keep this in mind. Since the PE ratio is not given, you will use this formula. You have to see this. This question asks the maximum exchange ratio. If the merged entity's PE ratio is given, then find the maximum exchange ratio, implying without MPS dilution. The PE ratio of the merged entity is given, so use that formula for MPS. What's the minimum exchange ratio for the target without MPS dilution? What about the merged entity PE? So for MPS 80, use the PE ratio of the merged entity formula. Solve these using my method, match answers. You will never truly understand by looking directly. These are very basic questions and easy chapter. After this, there is a specific type of question. It's about cash offer. See, cash offer heading has appeared. Cash offer questions that come in the exam are never standalone. They always include a point about share offer. There is a point on the share offer and then the cash offer. The current growth rate of the other company BCD is given. After the merger, when it comes under my control, when I merge or acquire that company, its growth rate will increase. The current market price and its expected dividend D1 are given. If dividend isn't given, it is D1 from security valuation notes. In this question, find the company's value using the dividend growth formula from business valuation. First, calculate KE by existing growth. Okay, and then you will find its new value through the new growth. You can find its value using a valuation approach. VT is definitely needed as no PE ratio is mentioned until the second part. For shareholder gain or loss, MPS at is required, and if nothing specific is mentioned, then it is based on MPS. How will you calculate MPS at VA plus VT? Because in this question, the pre-merger value is not given anywhere, so how will you find VT? Sorry, we won't take the pre-merger value in this question because the PE ratio is not given. Instead, we will take the calculated value of the target. Because we take the pre-merger value when it's not possible to calculate its value. It's possible to calculate value in this question. Don't take pre-merger. While calculating gain loss, you will take the market price itself because the formula mentions market price. And above it is written VA plus VT. Always remember that. Okay, let's see the question solution once. Solution was done in the class. First, I calculated the value of the other company, which came out to be 30 and the market price is 20. So when we take VT, I had you take the calculated value for VT. You have to take calculated value. Acquirer's calculated value wasn't possible. Market value synergy wasn't separate. It was included. Here's how I calculated the market price for gain loss. This is post-merger and acquirer's pre-merger market price. For the target, you will add the MPS. For the pre-merger target's gain loss, take the MPS here. Don't take the calculated value for gain loss. The acquirer after the acquisition should have this value. When we look at the target's gain loss, we will compare it with the pre-merger MPS. Always follow your notes precisely, you will avoid mistakes. Keep this in mind. The second part is about cash offer. You will need EPS and other things. So in second part, 10% rate is given for the opportunity cost. The PE ratio of merged entity is said to not change after the merger. For MPS 80 in the second part, use the PE formula. See, you should examine the question in every aspect. After this, here is another question. In this, it asks the maximum price, how much cash per share you can give. So you apply that same formula. If nothing is said, then without dilution of MPS. Without dilution of MPS. The minimum price is asked, how much will the other management accept without dilution of MPS. How much will they be willing to offer for their controlling interest, and this means that the promoters are offering their complete holding. In this case, what minimum price will the other management ask for? They ask for the target's minimum market price, which is 24. What's the extra point in this question? The target company will ask for what minimum amount to sell only their controlling interest, that is the promoter's holding, meaning how much minimum cash will the promoter people ask for. Listen carefully, a special point, the target company had 10 lakh shares outstanding. 40% of shares 4 lakh with promoters. After this, it was mentioned in the question that the promoter C people were in the company's management. When I buy the company, I will pay them 4 lakh rupees less salary per annum. So that the overall benefit, I mean the saving that will be done per annum in the merged entity. The 30 lakh present value becomes a market value synergy, first part. In this part, the other party will incur a loss of 4 lakh every year. So if we do PV, their loss of remuneration per share will be 30 lakh. And you know who were the people in the top management? These people were the promoters. They were the promoter shareholders. These shareholders will incur a loss of 30 lakh rupees, and the question asks for the minimum cash they will demand. This was asked and it's a very good point, so do look carefully. How much will the promoter shareholders request? They will ask for pre-merger market price 24. Plus the promoter shareholders loss is 30 lakh. Promoter shareholders shares are 4 lakh, and then you have to divide by that. Target company had 10 lakh shares, don't divide by this. 30 lakh loss is solely incurred by promoters and losing 7.50 per share, so they will ask for this minimum. Had the question asked for non-promoter shareholders minimum, they'd only ask for 24 with no other losses. So they would only ask for 24. It's a well-drafted question. This point is completed. This is a simple acquisition value question that you need to calculate. You will determine both VAT and VA, where VA is the calculated value. Data is provided to calculate the acquirer company's value. Cash flow and merged entity valuation data are provided. Both are calculated similarly, then the question is solved. Then next question is financial feasibility. And in the same topic. So in the financial feasibility, see all this about. Consideration is mentioned over here. The amount you will realize from debtors and inventory is also given to you. You will deduct amounts from debtors, inventory, and also the other party's cash. Some students are overthinkers. They say, sir, we have done everything for the liability. We have also realized the debtor, cash, and inventory. Then let's also realize the plant and equipment by selling it. The question never said it was realized. We took cash and you get it too. Can't we assume plant and equipment assumptions? No, don't make such assumptions. And see, the question will never say that. Because you are buying the entire other company, you have settled all its liabilities. You have realized all its assets. And now if you sell its plant and equipment, then why did you buy this company? So if you bought it and are also selling its plant and equipment, what is left of that company? Its plant and equipment must have been its main worth, and you must have bought it for that. And so you should not unnecessarily use your brain to make assumptions. I have clarified these doubts for many of the students. This is a demerger question. All the data is given. See, the demerger is happening on 1st April. And for you, Fortune India's balance sheet is as of 31st March and the Fortune Pharma's balance sheet is as of 1st April. On 31st March, there was a company called Fortune India which operated in two divisions, Pharma and FMCG. On 1st April, Fortune India separated the Pharma division, creating Fortune Pharma Limited. Fortune Pharma came into existence on 1st April, so Fortune India's 31st March data must combine Pharma and FMCG assets plus liabilities. For Pharma company, the data must have come as it is. So in Fortune India on 1st April, if you see, after the demerger, the remaining assets and liabilities will be of the FMCG division, which you can calculate. Its total asset liability. Subtracting pharma from pharma plus FMCG is okay and will be useful. All the data is given in this question. It asks how many shares the other company will issue and in what ratio. For that we have done some calculations. I will directly revise it for you from the solution according to the question's data, because we can't solve every question in revision due to less time. See, Fortune India Limited. It had two divisions. This division was transferred here on this date. This chart is important to avoid mistakes. After 1st April, Fortune India will have FMCG and Fortune Pharma will have Pharma. You can calculate number of shares that will be outstanding in Fortune Pharma, because the number of shares outstanding in Fortune Pharma will be same as it issued to the shareholders of demerged company. So how will you calculate that? You can calculate the EPS of Fortune Pharma. You can find out what Fortune Pharma's future EPS will be, because Fortune Pharma's future MPS and PE ratio are given in the question. The MPS of Fortune Pharma and the EPS data for Fortune Pharma are in the question. It's given. You can calculate that. Sorry, the MPS data is provided, which means you can calculate its EPS. If you get its EPS, Fortune Pharma's upcoming year profit is given, and Fortune Pharma's profit. This profit is given. The profit divided by EPS yields the number of shares, and these outstanding shares represent the quantity issued to the demerged company's shareholders. Hence, you can tell the ratio. Alright, the second point in this question now asks us to consider for Fortune India Limited what exactly will be its market price of the FMCG after demerger. So how will that come? You can find out its EPS after the demerger. The PE ratio is given in the question after the demerger. How to calculate the EPS after the demerger? Do you know the profit after the demerger? The profit after the demerger, the number of shares will remain the same for the demerged company. So this came after demerger. We calculate the book value per share for both companies after the demerger. Fortune Pharma's assets and liabilities are given, then divide by number of shares. You have to calculate Fortune India FMCG's assets and liabilities. Divide by its shares for book value. See, I have now revised this question for you. This is a normal reconstruction question. Do it in the same way. There is nothing special. A normal question on bonus issue. If you do the same, it will be done. For the class students, you have to revise the class solutions. This is of equity buyback. We have to calculate post buyback earnings per share in this question. So this is a basic question. Look at this question. It's from the equity buyback topic. You are buying back 20% of the shares in this. Market capitalization of companies 15,000 crore, EPS and PE ratio are given. Using current EPS and PE, you find MPS. From the current MPS and market capitalization, determine the shares before buyback. It's reverse calculation question. Use your brain. Such questions are easy to solve. And after this, the post buyback market price per share is given as an equation in the question. Post buyback PE ratio remains unchanged even if it's unstated. The post buyback MPS is provided and the PE ratio remains as given. You can calculate EPS after buyback. EPS after buyback into PE ratio gives MPS after buyback. And after this, are you taking a loan at 10% interest rate for the buyback? It is written in the question that you are going to pay the buyback amount by taking a loan. Now you are asked to determine the exact interest amount that you will then have to pay on taking the loan. So how to calculate this? Use your brain a little. You have all the data, put it in the EPS after buyback formula. Just input data into EPS after buyback formula for the answer. From the market price data, calculate your current shares. With 20% of shares bought back, you will then have the number of shares after buyback. The earnings available to shareholders before buyback are calculated using the shares and EPS. So you can calculate the EPS after buyback because you have the MPS after buyback and the PE ratio. So this is the EPS after buyback. With all your data, use the EPS after buyback formula where EPS after buyback equals the earnings before buyback just calculated minus interest on loan into 1 minus tax rate. Divided by shares after buyback, loan interest is the balancing figure. In the second part, it asks for the loan amount. What will be loan amount? Interest rate is 10%. Interest on loan is calculated by loan amount into interest rate. So can't you find the loan amount? After this, the third part. Buyback premium per share and its percentage over current market price. How is it calculated? First, find buyback price. How will the buyback price be calculated? For how much amount did you do the buyback? The amount of loan you took was for the buyback. Divide by how many shares are you buying back and you get the buyback price per share. The current market price per share is given. This is buyback premium. If you get buyback premium per share, what will it be in percentage? 5,000 on a current market price is 15,000. This premium percent. This was simple and it's completed. Look at the next question related to this. Of buyback. A company holds 100 lakh surplus cash, will distribute 27% to shareholders, not for free. To buy back shares, I have to pay money. I have surplus money in my treasury and I have to pay 27% of it. Meaning I will buy back shares by paying 27 lakh rupees. This time, since no buyback loan is required, you will find no mention of it. I will do the buyback with treasury funds. Its total amount is 27 lakh. The finance manager carefully estimated that for the buyback, the specific buyback price per share, the share price after repurchase, the market price after the buyback will be 10% higher than the buyback price. You are asked in first part to find the buyback price. So let's assume it to be X for now. Market price after buyback 1.10x. After this, the outstanding shares today are 10 lakh and the current EPS is 3 rupees. And from this, calculate the current earnings. Before the buyback, you can find out it's 30 lakh. It will be useful. So the price at which the shares can be bought back. To find it, a different method applies. The question gives post buyback market capitalization as 210 lakh. What is market capitalization after buyback formula? The formula for market capitalization after buyback, I have had you write it down. MPS after buyback into shares after buyback. MPS after buyback 1.10x, assuming the buyback price per share is X. We've written this. Market capitalization after buyback is given. We need to find shares after the buyback. So how will you find this? You know the number of shares before the buyback is 10 lakh minus how many shares have been bought back. We don't know. But how to find it? The buyback amount is 27 lakh. Divide by buyback price per share to know number of shares bought back. Then minus this from 10 lakh to get shares after buyback. An equation will be formed. Find X from this and the buyback price per share will automatically be calculated. Look at data and think about which equation to put it in. The data in notes is useful for you. Memorize the notes and make no mistakes. Second is also simple. How many shares are being bought back? Total amount buyback price per share is found. After this, what will be impact on EPS after buyback? So what are earnings before buyback? After buyback, number of shares. So EPS after buyback is found. So now this topic and all its questions have been revised by me for you. Okay. So you shouldn't have any problem with this now. The question revision was a bit fast because it's for other students. So we cannot spend too much time on revision on YouTube. Okay. Because to solve each question, it took us up to 20 minutes in class, right? Solving class questions took 20-25 minutes. So we cannot spend that much time here. You understand because I revised concepts, you can do it yourself and I have covered the special points. Then you should revise and then go through the questions from the class solutions. If you are a class student, otherwise if not, then from the notes. Follow the steps to find the answer, then match your answer and ask if you have doubt. Some students might feel, sir, please give us the class solutions too. Look, that is absolutely not possible. Don't even message for that. I will just say no. Because not everything can be given. Those will never be shared. I am stating today that these will not be shared. So please don't message for that. You should also understand some things. The things that are shareable, like notes, we share them for free. So this completes our revision video today. If you liked it, then please leave a comment and message me. And you can also recommend it to your juniors. You can share it with them if you like it and if you understand it. That's all for today. Thank you.